Hello guys, good evening. Please confirm, is the audio video clear? Shall we begin? Yes. So are you ready? It's going to be a super intense session. Today's session will be all about PGBP and tomorrow it's going to be all about capital gains. All right. Now, in today's session and in tomorrow's session, our focus is going to be more on the provisions aspect, on the conceptual aspect, and less on the computation. Because what I believe is, if you're strong with your concepts, then your computation part will anyways be taken care of. All right. So we will focus first on the concepts, on the provisions, because the thing is, the problem that students face is revising the entire PGBP, that entire set of provisions quickly. That is the biggest problem, right? Because when once you start revising, it keeps going on and on and on and on. So my objective is to help you finish off your revision fast. All right. So on that note, let's begin our very first discussion under PGBP. We will start off with some basic concepts. Now, there are some incomes which never come under PGBP head at all. For example, dividend income, it always goes to which head? Dividend income always goes to the head IFOS. Even if my business is buying and selling shares, guys, still my dividend income will go to the IFOS head. Similarly, even lottery winnings will always go to which head? Even lottery winnings will always go to IFOS head. Then answer my question. I have an illegal business. I am smuggling gold from Sri Lanka. Example, I am smuggling gold from Sri Lanka. I am doing an illegal business. Will this business income also go to PGBP? Yes, even this will go to PGBP. It doesn't matter whether it is legal business or illegal business, it will be taxed under PGBP. PGBP covers both legal and illegal businesses. Then the next question, I am having an agricultural business. From my agricultural business, I am earning income. This income is exempt. Agricultural business, to earn this income, I am incurring expense also. I am having some non-agricultural business also, which is taxable. The expense which I have incurred relating to agricultural business, can I adjust this expense against my non-agricultural business income? No, I can't. If my income is exempt, then corresponding expenses I'll have to ignore. If my income is exempt, corresponding expenses I'll have to simply ignore. If my income is exempt, then corresponding expenses I cannot subtract against taxable incomes. Right? So these are three basic points under PGBP. Now listen to my next point. Imagine this story. Let us say a Nestle Maggie ban. Do you remember that? Sometime back, there was a case going on against Nestle and Maggie was banned. Okay, so there was this particular lawyer, let us say, who fought the case against Maggie. And he won the case. Maggie was banned. Now, a lot of parents all over the country, they sent gifts to this lawyer. This gift will be taxed for the lawyer under which head? Gift means straight away IFOS? No. Always remember, guys, when you get gifts from employer, these gifts will go to which head? Gifts from employer goes to the salaries head, right? When you get gifts from persons who are voluntarily giving you gifts as a part of your business or profession, did the lawyer do something extraordinary? No, the lawyer did something as a part of his day-to-day business or profession. It is his day-to-day business or profession to fight these cases. So the lawyer gets something voluntarily. The parents are voluntarily sending gifts to the lawyer. The lawyer did something as a part of his day-to-day business or profession and he received something voluntarily from a person. This will go under the head PGBP. These gifts will go under the head PGBP. All other gifts generally go to the head IFOS. Okay, so in case the lawyer is receiving gifts from a person, in case a person is receiving gifts from another person, he is getting these gifts voluntarily. The lawyer is not asking for this. The lawyer is getting this voluntarily. He is receiving it voluntarily and these gifts are relating to his business or profession. He did something as a part of his day-to-day business or profession. Relating to that, he is receiving something voluntarily. No doubt it is a gift, but it will go under the head PGBP and not under the head IFOS. We already have 4 solid learnings. These 4 learnings will be tested for us only in our MCQs. Okay, now let us start, guys. We're going to be doing each adjustment one by one. The first, biggest, and the most important adjustment in your PGBP chapter, depreciation. Listen to me carefully. If you want to claim depreciation, first of all, you have to fulfill some conditions. You have to fulfill the conditions. Condition number one, the assessee should be the owner of the asset. Condition number one, assessee should be the owner of the asset. In case, now relating to this, we have some points to discuss. Point number one, let us say it is land, or okay, not land, land is not depreciable. Let us take building. Let us say it's a building, okay, and let us say this person, Mr. Blue, he is the registered owner of this building, okay. This person, Mr. Red, guys, by the way, registered owner means what, you understand? Registered owner means in the property papers whose name is written in the property papers, according to the government, according to the registrar, who is the owner? Mr. Blue, all right. But this person, Mr. Red, he is the person who has possession of the property. This person, Mr. Red, he has either paid the consideration or he is willing to pay the consideration. And between Blue and Red, there is a written agreement saying that the property will be sold to Red. Now tell me, who will be considered as the owner of this building? Who will be allowed to claim depreciation on this building? Red or Blue? Blue is a registered owner, but Red has possession of the property. Red has paid or is willing to pay the consideration. Red has a written agreement in his name according to which Blue is going to sell the property to Red. Depreciation will be claimed by Red and not by Blue, because here part performance comes to your mind. Part performance, Section 53A of TOPA comes to your mind, Transfer of Property Act. It is not necessary that the owner has to be a registered owner. Even though he is not a registered owner, under 53A of TOPA, part performance has happened. He has possession of the property. He has paid for the property. There is a written agreement according to which Red is going to be the buyer of the property. If all these conditions are fulfilled, even though Red is not the registered owner, it is Red who will be claiming depreciation. All right, now listen to the second point under the owner condition. You know that there are two kinds of transactions. There are hire purchase transactions and then there are installment purchase transactions, guys, right? What happens in hire purchase transaction? In hire purchase transaction, I've purchased the goods from the seller. I am going to pay for the goods in installments. What happens if I don't pay any installment? Seller will take away the goods back. That is a classic hire purchase transaction, right? And what is installment purchase? I went to Chroma to buy an iPhone. I told Chroma, see, I will pay in installments only. I'm going to pay one by one every month. I'm going to be paying an installment. Now, if I don't pay any installment, what will Chroma do? Can Chroma take away the iPhone back from me? No, Chroma can only sue me. They can only sue me. They can't take the iPhone back from me. So there are two kinds of transactions, hire purchase transactions and installment purchase transactions. In hire purchase transactions, if I don't pay the installment, the seller will take away the goods back from me. The seller will confiscate the goods back from me, which means when will I become the owner? When will I become the owner? I will become the owner in hire purchase transactions only when I pay the last installment, guys. Perfect answers I'm getting from you all. Very good, guys. In hire purchase transactions, I will become the owner only when I pay the last installment. Yes, but in installment purchase, when did I become the owner? Immediately. Now itself, I've become the owner. In hire purchase transactions, even though I am not the actual owner right now, even though I will become the owner only later, still now itself I can claim depreciation. In hire purchase transactions, yes, guys, what I just said was right. In hire purchase transactions, even though right away I am not the owner, I can still claim depreciation. Even though I will become the owner only later, only when I pay the last installment, only then I will become the owner, no doubt. But still, now itself I can claim depreciation. But I will claim depreciation on what amount? Will I claim depreciation just on the principal amount, or will I claim depreciation on the principal plus interest amount? I will claim depreciation only on the principal amount. Just this principal amount. This is called as cash price. I will claim depreciation on the cash price component. But in installment purchase, now itself, I became the owner. So I will claim depreciation on what amount? On the principal plus interest amount, or just on the principal amount? I will claim depreciation on the principal plus interest amount, which is called what? Which is called as higher purchase price. It's called as a higher purchase price. Understood, guys? So our very first learning, our very first adjustment is depreciation. Under depreciation, what are we learning? What is our first condition? We are learning the conditions. Our first condition is that the assessee must be the owner of the property. Owner of the property means he must be the actual owner of the property. He must be the legal owner of the property. But we have two special points regarding owner. In case my assessee is not the registered owner, in case my assessee is not the registered owner, let us say blue is a registered owner, but red only has the possession of the property, he has paid the consideration or he is willing to pay the consideration, and there's a written agreement between the buyer and the seller. If all these conditions get fulfilled, even though Mr. Red is actually not the owner, still under 53A of TOPA, part performance deemed to be the owner, Red can claim depreciation. Then we learned in case it is a hire purchase transaction or installment purchase transaction, they are two different things. In hire purchase transaction, I am getting the possession of the goods from you today, but when will I become the owner? I will become the owner only when I pay the last installment. So which means till I pay the last installment, I am not even the owner, but still hire purchase transactions, I can claim depreciation. I can claim depreciation on what component? On just the principal component, on just the cash price, on just the principal component. This cash price is also called as initial value. Okay, in installment purchase, what happens in installment purchase? Even here, I will be paying installments. Monthly, I'm going to be paying installments. But today itself, as soon as I enter into the contract, today itself, I become the owner. Immediately, I become the owner. If I don't pay any installment, Chroma can't take away my iPhone back. Chroma can file a case against me. Chroma can sue me, but they can't take away my iPhone back. So in case it is an installment purchase, then I immediately become the owner and I can claim depreciation on the principal plus interest component. See, I'm going to be paying EMIs, right? Each EMI will have a principal component and an installment and an interest component. Each EMI will have a principal component and an interest component. I will claim depreciation on the entire amount on the higher purchase price. Higher purchase price means principal plus interest component both put together. Perfect understanding, guys. Is everybody crystal clear with my very first condition? Yes, my very first condition was that my assessee should be the owner of the asset. Okay, now coming to the second condition. The second condition is that this asset of mine should be an eligible asset. This asset of mine on which I want to claim depreciation should be an eligible asset. Now, what do you mean by eligible asset? Eligible asset means, point number one, this asset should be used for my business or profession. This asset should not be used at home. It should be used for my business or profession. Condition number two, it may be a tangible asset or it may be an intangible asset. If it is a tangible asset, it will fit under three buckets. If it is tangible asset, it will fit under three buckets. What are the three buckets, guys? Number one, building. Number two, plant and machinery. Number three, furniture. These are the three buckets. Eligible assets would be so totally I will have four eligible assets, guys. I will have building, plant and machinery, furniture and intangible assets. Totally I will have four eligible assets. Okay, now when I talk about intangible assets, I'm covering all intangible assets. They can be know-how, they can be patents, trademark, license, franchises, can be anything. But intangible assets should not be what? Anybody. Intangible assets should not be what? Perfect answers. It should not be goodwill. Whether goodwill of business, whether goodwill of profession, it should not be goodwill. It can be any other asset, but it should not be goodwill. Okay, so come on, guys. Once again, my second condition, my first condition was that my assessee should be the owner. My second condition is that my asset should be an eligible asset, which means it should either be building, plant and machinery, furniture, or it should be an intangible asset. If it is an intangible asset, it may be goodwill of business or it may be goodwill of if it is intangible asset, it should not be goodwill of business or goodwill of profession. It can be any other intangible asset, like it can be trademark, patent, copyright, but it should not be goodwill of business or profession. In simple words, can I say that goodwill of business or profession not depreciable? Yes, I'll make a list of not depreciable assets. Let us make the list of most common not depreciable assets. What will your first point be? Land, Land is not depreciable. Then number 2, I'll put goodwill of business profession, not depreciable. Then anything else that comes to your mind. Number 3, livestock. Very good. Livestock is not depreciable. What is livestock? Animals. Then what else? Number 4, tea bushes. Tea bushes also not depreciable. Number 5, human body parts, not depreciable. Then number 6, your inventory, your stock in trade also will not be depreciable. These are the most common assets which are not depreciable. Okay, this was our second condition. So my first condition was that the assessee should be the owner of the asset. My second condition was that my asset should be an eligible asset. Now coming to the third condition. The third condition is use. My assessee should be using the asset, but he should be using the asset for what? He should be using the asset only for his business or profession. Use may be of two types. Use may be active use or passive use. Active use means I'm actively using this laptop. I'm actively using my phone. I'm actually using the plant and machinery. Active use. What is passive use? Passive use is nothing but I'm keeping the asset ready for use. Passive use is I'm keeping the asset ready for use. The nature of the asset is such that I have to keep it ready for use. What are the two most common examples of passive use? Number 1, fire extinguisher. And number 2, your spare parts, your nuts and bolts and all. We always keep, like for example, if a plant and machinery has a very important component, if this component stops working, gone, entire production process will stop. So we have to keep a spare part ready. We have to keep a spare part. We have to keep that component, different spares of that component. We have to keep them ready. As soon as this component is gone, we have to replace it. So fire extinguisher, spare parts, we keep them ready for use. Even that gets covered under use. Okay, so what was our first condition, guys? First condition, assessee should be the owner of the asset. Second condition, it should be an eligible asset. And third condition, I must actually be using the asset. I must be using it for my business or for my profession. So this was our very first discussion under depreciation, where we learned about the conditions. Now listen, guys, what is the how are we going to calculate depreciation? Are we going to get full year's depreciation? Are we going to get half year's depreciation? How are we going to calculate depreciation? This is going to be the second part of our depreciation discussion. See, how are you going to calculate depreciation? That depends upon what year is it. Is it the year of acquisition? Is it the year in which we acquired the asset, or is it any subsequent year? In the year in which you acquired the asset, three things are possible. Either you will get full year's depreciation, or you will get half year's depreciation, or you will get no depreciation. When do you get full year's depreciation? In the year of acquisition, if you put the asset to use for at least how many days? In the year of acquisition, if you put the asset to use for at least 180 days, then you get full year's depreciation. In the year of acquisition, if you put the asset to use for less than 180 days, then you get half year's depreciation. But in the year of acquisition, if you did not put the asset to use at all, then you get no depreciation, right? So in the how are you going to calculate depreciation? How much depreciation are you going to get? This depends upon what? That depends upon how many days did you put the asset to use for. In the year of acquisition, in the first year, in year 1, if you put it to use for at least 180 days, then you will get full year's depreciation. In the year of acquisition, if you used it for less than 180 days, you'll get only half year's depreciation. But in the year of acquisition, you did not put it to use at all, then you will get no depreciation at all. Subsequent years, you tell me, what are my two options? 2 options, 3 options? How many options? Subsequent years, I'll have only 2 options. Either I will get full depreciation, or I will get no depreciation. When will I get full depreciation, guys? Even if I put the asset to use for some days, if I put the asset to use even for few days, even if I use the asset for 1 day, I will still get full depreciation. But if I did not put the asset to use at all, then I will get no depreciation at all, right? So subsequent years, how much depreciation I will get? Either I will get full depreciation. If I put the asset to at least some use, I will get full depreciation. But if I did not use the asset at all, then I will get no depreciation. Now you answer my question. Let us see how well you know these concepts. Listen to me. I'm going to give you an example here. Let us say my asset was acquired. Date of acquisition was 1st of June 2021. This asset was put to use on 1st of January 2023. You tell me in which year, how much depreciation will you give? Let us say it's a plant and machinery, 15% depreciation. Which year, how much depreciation will you give? Option 1, previous year 21-22. Option 2, previous year 22-23. Come on, tell me. Previous year 21-22, 15%. Previous year 21-22, 7.5%. Previous year 21-22, 0%. Previous year 22-23, 15%. Previous year 22-23, 7.5% or 0%. What will be your answer? In 21-22, how much depreciation you will give me? 21-22, you will give me no depreciation. Why? Because I did not put the asset to use at all. In 21-22, I did not put the asset to use at all. So you will give me no depreciation. It is a year of acquisition. You agree with me? This is a year of acquisition. 21-22 is a year of acquisition. Year of acquisition, no use. You will give me no depreciation. 22-23 becomes subsequent year, guys. Subsequent year, at least some depreciation, at least some use, I will get full depreciation. Even 1 day used, I will get full depreciation. Got it? So in 21-22, I will get no depreciation. In 22-23, even part of the year, even 1 day I use, I will still get full depreciation. Perfect understanding until here, everybody? Yes, this calculation part, did you understand? This calculation part is a little confusing. A lot of times students go wrong, but you guys will not go wrong here at all. Yes, subsequent year, even 1 day put to use, I will get full year's depreciation. Okay, now listen to my third part. So under depreciation, first we learned the conditions. First condition, my assessee should be the owner of the asset. Second condition, assessee, the asset has to be an eligible asset. Third condition, the asset has to be used. The asset should be used for business or profession, active or passive use. Then we learned the second part, how do we calculate the depreciation? In the year of acquisition, I will get full, half or no depreciation, but subsequent year, I'll either get full depreciation or I'll get no depreciation. Nidin is asking us a question, isn't it below 180 days? So shouldn't it be 7.5%? Listen, Nidin, you are right, it is less than 180 days, but that less than 180 days or more than 180 days, when do we check, Nidin? Only in the year of acquisition. Year of acquisition, did we put it to use at all? We did not use it at all, right? So in the year of acquisition, no depreciation. Subsequent year, 22-23, do you look at number of days? 22-23, do you look at 180 days, Nidin? We don't, right? So that is why 22-23, even though we put it to use for less than 180 days, we will still get full year's depreciation. All right, now listen guys, going to the third discussion. How do you calculate depreciation? What is the method of depreciation? Yes, Safnina, got your point. I'll put up the notebook. This notebook I'll put up on my Telegram channel. Do not worry about it. Now listen guys, what are the two methods of depreciation? We have two methods of depreciation, WDV method and SLM method. WDV method and SLM method. SLM method, we will keep it aside. We'll see it later. Our entire focus is on WDV method. Now in WDV method, if I have an asset which belongs to the same category of asset and also has the same depreciation rate, I will put them into a block. So in income tax, we have a unique concept of block method. In this block method, what do we put? We put all assets which fall under the same category and have the same depreciation rate. Two things, same category and have the same depreciation rate. I'll put them into one single block. Now you tell me, how many categories of assets do you know? How many categories of assets do you know? How? 3 categories. Sid, you will be knowing 4 categories. There is building, there is furniture, there is plant and machinery, there is intangible asset. So we know 4 categories of asset. Under each category of assets, we have different depreciation rates. So all assets which fall under the same category and which also have the same depreciation rate, I put them into one single block. Okay, now quickly looking at the depreciation rates for building. For building, we have totally 2 depreciation rates. What are the 2 depreciation rates? If it is a residential building, then 5%. Generally, all other buildings, 10%. Okay, then if I talk about furniture, how many depreciation rates? Furniture, only one depreciation rate, which will be 10%. If it is plant and machinery, here, how many depreciation rates we have for plant and machinery? Here we will have 3 depreciation rates. What are the 3 depreciation rates? Number one, you have 40% depreciation rate. When do you have 40% depreciation rate? If it is aeroplane, or if it's a ship, or if it's a book, or if it's a computer. For all these kind of assets, 40%. And most important, air, water, pollution control equipment, even here, 40%. Perfect answer, guys. Then when do you apply 30%? Tell me. 30%, 30%. Yes, Sona, even windmill covered under 40%. When do we apply 30% limit? 30% in case it is a car or a bus or a lorry which is used in the business of giving them on hire. If it's a motor car, motor bus, lorry, taxi used in the business of running them on hire, then 30%. All other plant and machineries, would be 15%, right? So air pollution control equipment, then solid waste control equipment, energy saving devices, computers, scanners, UPS, books, all that comes under 40%. Car, bus, lorry, if in the business of giving them on hire, 30%, all others 15%. Then two more things you should remember. In case it is a car which is acquired and put to use, in case it is a car which is acquired and put to use in a particular period. Does a period come to your mind? Does any date come to your mind? 23rd August 2019 to 31st March 2020. In this period, if a car is acquired and put to use, then what will the depreciation rate be? Depreciation rate will be 30%, right? Then in case you have the same thing, car, bus, lorry, in the business of giving it on hire, if you have any car business or any car, bus or lorry in the business of giving it on hire, but acquired and put to use in the same period, then it was going to become 45%. All right. And then my last bucket, intangible assets. Intangible assets, what will be the depreciation rate? Only one rate, which is 25%. All right, so giving you one quick summary of our rates. Building is simple, residential building 5%, all other buildings 10%. Furniture is simple, only one rate, 10%. Plant and machinery, aeroplane, ships, books, computers, air, water, pollution control equipment, windmill and all, 40%. If it's car, bus, lorry in the business of giving on hire, 30%. All other plant and machineries, general rate 15%. If it is a car which is being acquired and put to use in that specified period, 30%. If it is car, bus, lorry in the business of giving them on hire, acquired and put to use in that period, then 45%. Did you notice, guys? Acquired and put to use. Acquired and put to use. Both should happen in this period. Now, how confident are you about the depreciation rates? How confident are you about the depreciation rates? 100% confident? Shall we test our confidence levels? Listen, you will tell me, okay? My focus right now is on vehicles only. All right, my focus right now is just on the vehicles. My assessee may be in the business of giving them on hire, or my assessee may not be in the business of giving them on hire, right? If my assessee is in the business of giving them on hire, all right, I'm talking about vehicles like car, lorries, bus, taxi, you know, I'm talking about these kind of vehicles. My assessee is in the business of giving them on hire. My assessee acquired them and put the asset to use in the period 23rd August 2019 to 31st March 2020. What depreciation rate? 45%. Perfect. But what if it was acquired and put to use at some other time? Then what depreciation rate? Then 30%. Perfect. If assessee is not in the business of giving it on hire, then let us say I talk about car separately. I have a car. This car was acquired and put to use in this period 23rd August 2019 to 31st March 2020. What depreciation rate will you give me? Not in the business of giving on hire. How 45%? It's going to be 30%. Not in the business of giving on hire. What if it was acquired and put to use at some other time? Then how much depreciation will you give me? You will give me 15%. All other vehicles, for example, if I don't have space here, who is this? Samrud. You can do all these drawings later. Okay, please listen. All other vehicles, let us say lorry. Lorry acquired and put to use in this period. What depreciation rate? Tell me. Lorry acquired and put to use in this period. It will still be 15%. It will still be 15%. Are you understanding, guys? You know where students get confused? Students get confused in this bucket. Assessee is not in the business of giving on hire, okay? And let us say it is a lorry. Assessee is not in the business of giving them on hire. Acquired and put to use in this period, it will be 15% only. All right. When does the rate increase? When does the rate increase to 45 and 30? The rate increases to 45 and 30 only for two assets. Asset number one, vehicles. Assessee is in the business of giving them on hire. Vehicles, assessee is in the business of giving them on hire, then it increases to 45%. And car increases to 30% in this period. If assessee is not in the business of giving on hire, then lorry, truck will always be what? 15%. Now you understood. Assessee is not in the business of giving them on hire. Lorry, truck, bus will always be 15%. A lot of times students go wrong here. When will you think? If assessee is in the business of giving them on hire, then you will think about 45 and 30. If assessee is not in the business of giving them on hire, only for car you will think about 15 and 30. Everything else straight away 15%. All right, guys. So in simple words, assessee has a car. This car and assessee is in the business of giving this car on hire. Then acquired and put to use in this period. Then depreciation rate. Quick answer. Guys, why are you still making a mistake? Who is saying 30%? Car, assessee is in the business of giving them on hire. Assessee is in the business of giving on hire 45%, right? All those of you who are saying 30%, think. What if it is lorry? Assessee is not in the business of giving on hire. Acquired and put to use in this period now, 15%. Now, Tharu. These two questions, if you answered correctly, then your understanding is perfect. All right, now let me take you to the next discussion. So this was our discussion regarding the depreciation rates. Now coming to the next discussion, we are still talking about depreciation only. We learned about the two methods, WDV and SLM method. And under WDV, we spoke about same category, same depreciation rate. We put under the same block. We spoke about the depreciation rates. Now listen, guys, what is the structure of our calculation? How are we going to calculate? What will be our steps for computation? Our next discussion. See, you will always start with opening WDV in the beginning of the year. For your November 2022 examination, your previous year in the question will be 21-22. Right? So for 21-22, you will start with opening WDV on 1st April 2021. To this, what will you add? You will add actual cost of assets acquired. Whenever you do actual cost of assets acquired, pause and think, is it less than 180 days or not? Why should you think less than 180 days or not? Because in the year of acquisition, if you put the asset to use for less than 180 days, how much depreciation you will give me? You will give me only half the year's depreciation. So that is why whenever you do actual cost of assets acquired, pause, check, think, is it less than 180 days or not? Okay. Then what do you subtract? You subtract monies payable for assets sold. Guys, listen, these terminologies can't change, okay? You cannot write purchase and sale here, okay? Put in the effort, write down, add actual cost of assets acquired, less monies payable for assets sold. Then what do you get? What's the net number called? Closing WDV on 31st March 2022. All right, then you will get a number. On this number, you will calculate depreciation, additional depreciation, as the case may be. Right now, my focus is on this actual cost number. In this actual cost number, what and all will you include? you will not only include the actual cost, you will also include installation expenses. I may incur some installation expenses to install the asset, even that I will include. For example, we may have some loading charges, we may have some carriage inwards. What are carriage inwards? To bring the asset till my factory, I had to incur some transportation charges, even that will be included in the cost of the asset. Then I may incur expenses to facilitate the use of the asset. I may incur expenses to facilitate the use of the asset. For example, I am incurring staff training expenses. The asset is a fancy plant and machinery. None of my workers know how to use it. So I had to, arrange for some training sessions to train these employees, to train these workers. I had to incur training cost. It will be added to the actual cost of the asset. All these points, guys, MCQs, classic points they can ask you. Okay, then you may incur whatever insurance expenses you've incurred, whatever power expenses you've incurred, whatever fuel expenses you've incurred before putting the asset to use, even that you will add to the actual cost. Sometimes you may incur regularization fees. Do you know what is regularization fees, guys? For example, building, can I construct any number of floors I want in a building? No, there's a limit, right? But if I want to let's say the limit is 2 floors, but I actually want to construct one more floor. So what will I do? I will pay a small regularization fees to the department. I will get permission from the construction authorities and I will construct one more floor. So whatever regularization fee I had to pay to construct one extra floor in the building, even that regularization fee I will add to the actual cost. Most important point, guys, interest. Interest, till when will you add to the actual cost? Whatever interest you've incurred till you put the asset to use, right? Whatever interest you have incurred till you put the asset to use, that interest you will add to the actual cost. See, let us say my assessee borrowed a loan from the bank. Okay, he borrowed the loan on 1st April 2021 to buy an asset. But the assessee actually gave the supplier money. The assessee actually purchased the asset from the supplier only on 1st June 2021. And the assessee put this asset to use only on 1st July 2021. Now you tell me, what will you do with the interest? Whatever interest I've paid for April to June or April to May, what to do with this interest? Whatever interest I've paid in June, what to do with this interest? Whatever interest I've paid for July to December, what to do with this interest? Tell me. April to May interest. April to May interest, what will I do? I will add to the actual cost. June interest, even see, June interest also I will add to actual cost. Why? June asset I purchased, but did I put the asset to use in June? No, I put the asset to use only in July. So July onwards, what will I do with the interest? July onwards, I will allow the interest. Allow it as in, I will debit it to my P&L account. July onwards, I will debit it to my P&L account till I put the asset to use. That is from 1st April 2021 to 30th June 2021, I will add the interest to the actual cost of the asset. Extremely important point from your examination perspective, not only MCQs, also full-fledged questions. Will you remember this, guys? Whatever interest you have incurred till you put the asset to use, what do you do with that interest? You add that interest to the actual cost of the asset. Perfect understanding. Then sometimes the government gives us subsidy. Sometimes the government gives us a grant. What to do with subsidy and grant? Subsidy and grant will be subtracted. Any subsidy received from the government, any grant received from the government for purchase of asset and all, we will subtract. So this was our discussion regarding the actual cost discussion. What and all will you include in the actual cost? We've discussed. Any questions regarding this, guys? Are we all crystal clear with this discussion until here? Yes, depreciation is one thing which I want you to be solid sure, because the thing is, from depreciation you can either get a full-fledged question also, or depreciation can be an MCQ adjustment also. Depreciation, they can test you from anywhere, from any corner. All right, you should be thorough with depreciation. Now listen to my next discussion. My discussion number 5 under depreciation. What if I acquired an asset, okay, and I'm making payment of the asset more than 10,000. I am making payment for one single asset. I am making payment more than 10,000 towards one single asset against one single invoice to one single supplier. How should I make this payment? I should make this payment only in specified mode. Should I say specified mode or should I say non-cash mode? Are they both same thing? They are different. I cannot say non-cash mode. I have to say specified mode. What are specified modes? How many specified modes do we have? We have 4 specified modes: account payee check, then account payee bank draft, then ECS, and then other electronic payments. If I make this payment in specified mode, will you let me add it to the actual cost? Will you let me add it to the actual cost? Yes. But if I make the payment in non-specified mode, then will you let me add it to the actual cost? Then sorry, I will not let you add it to the actual cost. Okay, so in case you are making a payment more than 10,000 rupees for one single asset against one single invoice to one single person in one single day. I'll add one more point: in one single day. Then how are you supposed to make the payment? You are supposed to make the payment in specified mode only. Only then I will let you add it to the actual cost. If you make the payment in non-specified mode, I will not even let you add it to the actual cost. Got it, guys? Okay, now listen. You tell me, cross-check will fall under which bucket? There's a question in the chat box. Cross-check will fall under which bucket? Specified mode, non-specified mode? Cross-check will fall under non-specified mode. Okay, guys, just give me one moment. I am so sorry for the disruption. Going forward now, going to the next discussion, the 6th discussion. We are going to be seeing some special situations now. These special situations not very important from the examination perspective, but the thing is, it's been really long since I asked a question from here. So according to me, in your upcoming examination, there can be at least one MCQ question from these special situations. Okay, so that is why listen to me very carefully. Now let us say there are two people in our story, person green and let us say person red. Okay, this person green had a car. He was using the car for his business purpose. It was his WDV was 1 lakh rupees. This Mr. Green, he sold this car to red. In the hands of green, what was the WDV of the car? 1 lakh rupees. He sold this car to red and he sold this car for 25 lakh rupees, guys. He got 25 lakh rupees for the car. Now tell me, who will be the owner of the car? Now, who's going to claim depreciation? Red is going to become the owner. Red will claim depreciation. But for red, what will the actual cost be? If the AO thinks that this whole transaction happened just so that there can be high depreciation for red, you tell me, higher the depreciation better or not good? Higher the depreciation better or lesser the depreciation better? Higher the depreciation better, because higher the depreciation, lesser will be the profit. Lesser the profit, lesser will be the tax. And that is what assessee wants. So if the AO thinks that the whole objective of this transfer was so that we can increase the cost of the asset, if we increase the cost of the asset, depreciation will increase. If we increase the depreciation, profit will reduce. If we reduce the profit, tax will reduce. If the AO thinks that the whole objective of this transaction was to increase the cost of the asset from 1 lakh to 25 lakh so that red can claim a higher depreciation, then what will the actual cost be? AO plus joint commissioner together will tell red what the actual cost will be. The actual cost will be determined by whom? No habis, you cannot straight away say 1 lakh. In such case, the AO and joint commissioner together, they will determine what the actual cost will be. They will determine and they will tell red, which will generally be 1 lakh. But in the examination, what will we write? In such cases, AO and joint commissioner will determine the actual cost in such cases. Is my first special situation clear? In my first special situation, my assessee is transferring the asset to another person for a very huge price. If the AO thinks that the whole objective for this transfer is to increase the cost, to increase the depreciation, to reduce the profit, and hence to reduce the tax, then for the buyer, for the owner, the actual cost will be the amount which is determined by AO plus joint commissioner. This is my first situation. Now coming to my second situation. In my second situation, again, I have the same two people. I have green and red. Okay, this time again, green has a car. Pen has stopped writing, just a moment. Why does this happen exactly when time is short? Just a moment, guys. Yeah, look at this. Perfect. Now, Mr. Green, again, he has a car and in his hands, the WDV is 1 lakh. Mr. Green has sold this car to Mr. Red for whatever price. But you know what Mr. Green did? Mr. Green again repurchased the car from Red. So Red resold the car to Green. Green repurchased the car from Red. And this time, Green paid 25 lakh rupees for the car. So what is this transaction? This is nothing but a transaction of sale and repurchase. What did Mr. Green do? Did you all understand the situation? Mr. Green has sold the car and then Mr. Green has repurchased the car. Sale and repurchase, guys. Now, who's going to be the owner? Who will claim depreciation? Green will be the owner. Green will claim depreciation. But for Green, what will the actual cost be? For Green, the actual cost will be the existing WDV number or the purchase price number, whichever is lesser, 1 lakh or 25 lakh, whichever is lesser, which will be 1 lakh rupees. Understood? Yes, guys, all this is a part of your syllabus. You will find all this in your study material. What is this? Students are asking, is it even a part of the syllabus? Yes, guys, this is a part of your syllabus. So the first situation, the first transaction is we sold the asset in such a way that the actual cost increases. In my second situation, we're talking about sale and repurchase. I am selling the asset. Why? Because I want to repurchase it at a higher cost. In such cases, what will the actual cost be? The actual cost will be the WDV number or the repurchase price number, whichever is lesser. Okay, this was my second situation. Now talking about my third situation, this is the most popular situation. In case you get a question in your examination from here, most probably it will either be the second situation or it will be the third situation. Okay, in my third situation, there is a sale and lease back. Here again, we have two people. We have Green and we have Mr. Red. This Mr. Red is, let us say, a leasing company. Let us say it's an NBFC. NBFC example, okay? Don't learn it as only NBFC. NBFC is only an example. This Mr. Green, what he did is he sold his car to Mr. Red. Why? Mr. Green needed money. WDV in his hands was 1 lakh. He needed money. He sold the car to Mr. Red. And let us say Mr. Red gave him 90,000 rupees for this car. Now, who is the owner of the car? Red becomes the owner of the car. But Mr. Green wanted this car. So what Mr. Red did is Mr. Red gave this car back to Green, but on lease. Now, what is Green going to give Red? Green is going to give rent to Red for this car. Who owns the car? Red owns the car. Who will claim depreciation on this car? Red will claim depreciation on the car. But for Red, what will the actual cost be? For Red, the actual cost will be whatever was the WDV in the hands of the giver, which is 1 lakh rupees. Which is 1 lakh rupees. Did you understand this discussion? This is our discussion regarding sale and lease back. In my first situation, what happened? I'll give you a quick summary. Listen, guys. In my first situation, my assessee has sold the asset. He has sold the asset in such a way that he wants to increase the cost of the asset. In such cases, AO plus Joint Commissioner will determine and tell you what the cost will be. In the second situation, we have sale and repurchase where my assessee is selling the car so that he's repurchasing it at a higher price so that he can claim depreciation at a higher amount. Nothing doing, Mr. Green. You can't do all this. Your actual cost will be your WDV number or the repurchase price, whichever is lesser. Third situation, what happened in a third situation? In the third situation, we did a sale and lease back. Mr. Green sold the car to Red, got the money, and then took the car from Red on lease. Genuine transaction. Mr. Red becomes the owner of the asset. He will claim depreciation on what price? See, for Mr. Red, what is the actual cost? 90,000, but not 90,000. In sale and lease back transactions, we will see what was the WDV in the hands of the transferor. Whatever was the WDV in the hands of the transferor, that will become the actual cost for the owner. Okay, so this was our third situation. Now coming to the fourth situation. In the fourth situation, I'm talking about just building. I'm talking about just building. The only asset which I'm talking about is building. Okay, my assessee owned this building. My assessee was using this building for his personal purposes. He was using for personal purposes. Will you give him depreciation? Of course, you will not give him depreciation, no, because he was using it for personal purposes. Now, what the assessee does is he brings the same building into business purposes, business or profession purposes. Now, will you let him claim depreciation? Yes, you will let him claim depreciation. Let us say this building was purchased for 100 rupees. The assessee used the building for personal purposes for 2 years. Third year, he is bringing the building for his business or profession. Now you will claim depreciation. Now this building will enter the block, but what will the actual cost be? Will the actual cost be 100? No, the actual cost will be 100 minus depreciation for year 1 minus depreciation for year 2. Tell me, year 1 and year 2, did you actually claim depreciation? Did you actually claim depreciation? No, it was used for personal purposes. Actually, we did not claim depreciation. That is why, what will we call this depreciation? We will call this deemed depreciation. Deemed depreciation means what? We will assume what if depreciation was claimed in year 1, year 2, then what would the net number be? This net number that you will get here, building 10%. So let us say 100 minus 10% for year 1 minus 10% for year 2, 81 rupees. This 81 rupees will enter the actual cost. This 81 rupees will enter the block. Year 3, you will calculate depreciation on 81 rupees. Did you understand? So this, but then guys, remember, this point is applicable only to building. Building was used for personal purposes and now it is converted into business or professional purposes. Instead of building, what if it was car? Instead of building, what if it was car? Then in that case, in year 3, when this car enters business or profession, what will the actual cost be? Tell me. For building, you do deemed depreciation and all. For car, you will not do deemed depreciation. So actual cost will be 100 only. Perfect answers, guys. Very good. Right? So for building alone, you have this concept of deemed depreciation. This concept of deemed depreciation doesn't apply to any other asset. It is only for building. The income tax department, the lawmaker, did not have an objective to differentiate like that. Just that when the law was made, the lawmaker imagined that building could be the only asset where this would happen. There's no reason that they did not do this deliberately. They did not do this deliberately, just that when the law was made, in the section, they just used the word building for this point. That is why the provision has become such that we apply this deemed depreciation concept only to building and not to other assets. Okay, this was our fourth special situation. Now coming to the fifth special situation. What if the holding company transfers an asset to Indian wholly owned subsidiary? Or what if wholly owned subsidiary transfers asset to Indian holding company? Who will become the owner of the asset? This buyer will become the owner of the asset. For them, now they will claim depreciation. What will they claim depreciation on? What will their actual cost be? Their actual cost will be nothing but WDV in the hands of the transferor. For the transferor, this is a transferor, right? For the transferor, whatever was a WDV, that same WDV will become the actual cost for the buyer. Understood, guys? Are we clear with this? In case my holding company transfers an asset to Indian wholly owned subsidiary, see, it may be for a consideration. Indian wholly owned subsidiary may be giving some consideration. Indian holding company may be giving some consideration. We don't care about that. This owner, for this owner, what will the actual cost be? Whatever is the WDV for the transferor, that WDV itself will become the actual cost for the owner. All right. Similarly, in my next situation, I may have an amalgamating company which is transferring its assets to amalgamated company. What is an amalgamating company? Amalgamating company is one which is joining another company. A Limited is merging with B Limited. A Limited is joining with B Limited. So A Limited's assets also will be transferred to B Limited. Now who's going to become the owner? B Limited is going to become the owner. Now B Limited will claim the depreciation. For B Limited, what will the actual cost be? Actual cost will be whatever is the WDV for A Limited, whatever is the WDV for A Limited, that itself will become actual cost for B Limited. Similarly, we may have demerger. We have a demerged company and a resulting company. I had a company, A Limited. A Limited was doing two businesses, paper business and steel business. Was not able to handle too much pressure. So A Limited made another company, X Limited. A Limited kept paper business. A Limited transferred steel business to X Limited. Now X Limited will become the owner of the steel assets. X Limited will claim depreciation on the steel assets at what price? At what price? And what will be the actual cost? Actual cost will be nothing but whatever is the WDV in the hands of demerged company A Limited in our example. So A Limited was having paper business and steel business. A Limited demerged into X Limited. So A Limited kept paper business with itself and it gave steel business to X Limited. Now all the steel assets will become X Limited's assets. X Limited will claim depreciation on steel assets. What will be the actual cost? Whatever was a WDV in the hands of A Limited, that itself will become the actual cost for X Limited. Okay, so this was our example regarding demerger. From these points, there's very high probability that you might get an MCQ question from these situations. Okay, are we crystal clear with all these situations, guys? One last point shall I discuss with you in these situations, and then we'll go to the next discussion, right? Listen to me. Listen to the next situation very carefully. This one is again an important situation. Listen. I have some inventory. This inventory I am converting into capital asset. Okay, and this capital asset I am going to use for my business purpose. I am going to use this capital asset for my business purpose. Till now it was inventory where you're giving me depreciation. You were not giving me depreciation. Now it becomes an asset which I'm going to use for my business. Now will you let me claim depreciation? Now you will let me claim depreciation, which means now it will enter the block. So what will the actual cost be? It will enter the block. What will the actual cost be? The actual cost will be FMV. FMV on which date? The actual cost will be FMV on the date of conversion. Are we following this, everybody? Yes, Jason is saying volume is low. Is the volume a problem for everybody? I think everything is fine at my end. Jason, I think you'll have to increase the volume of your speaker. All right, so listen guys, this is an extremely important situation. I had some inventory. It was inventory. So will you be giving me depreciation? No, right? On inventory, you don't give me depreciation. But then what did I do later? I converted this inventory into a capital asset and I'm going to use this asset for my business. Imagine a situation like this. Imagine I'm a real estate dealer. So I'm a real estate dealer. What will my inventory be? Land and building will be my inventory. I'm going to buy and sell buildings. Land and building will be my inventory. One of these buildings I decided to convert into my office. To do business, I need an office space, right? So one of those buildings which was my stock in trade, I converted it into my office space. Now that building was an inventory earlier, now it has become my office building. I'm going to do my business in that office building now. So now you will give me depreciation. What will the actual cost be? On what amount will you calculate depreciation? Whatever is the FMV on the date of conversion, on that amount you will calculate depreciation. This will become the actual cost. A lot of students are not aware of this. This might be a new learning for many of you. I hope you all grasped this really well. What will be the actual cost, guys? Whatever is the FMV on the date of conversion, that will be the actual cost. All right, whatever is the FMV on the date of conversion, that will be the actual cost. It was my stock in trade. That building, I was a real estate dealer. So that building was my stock in trade. Then I decided that to do business, I need a separate building. What is the point of going and buying another building? This building, which was my inventory, this building I converted into office building, which means from this office building, I'm going to do my business work now. So this office building becomes a capital asset, which I'm going to use for my business. If I'm going to use it for my business, now you will give me depreciation. But how will you give me depreciation? On what value will you calculate depreciation? On the FMV on date of conversion. All right, understood, Manasa? Right? So this was my discussion about all the special situations. Okay, coming to one last concept now. So under the depreciation adjustments, we do not lose focus. Okay, we began our discussion with what? We began our discussion with the conditions. We spoke about assessee, You should be the owner of the asset. Assessee, the asset should be an eligible asset. Assessee, you must actually be using the asset for your business or profession. Then we learned the second concept, how to calculate depreciation. We said you will first see year of acquisition or subsequent year. Year of acquisition only 180 days and all is relevant. Subsequent year 180 days not even relevant, we spoke. Third concept we learned WDV SLM. Two methods we have, but WDV only we are focusing on right now. WDV, same category of assets, same depreciation rate, put them into the same block. Each category depreciation rates we learned. Very important chart we had here about vehicles. Okay, then after that, what did we learn? We spoke about the steps. How do you calculate the block numbers? Then we spoke about 10,000, more than 10,000 you're paying, pay by specified mode only. Then we learned all the special situations one by one. Until here, I am hoping you are crystal clear. Now listen to the next discussion, guys. I sold my depreciable asset. I had a depreciable asset and I sold that depreciable asset. Whenever I sell the depreciable asset, what will you check? You will check what happened to the block. Did the block become empty? Two things are possible. Guys, listen, let me give you one small disclaimer. Whatever I'm discussing with you about this sale of depreciable asset, each of you in your regular class, you might have learned it in a different manner. Every faculty has their own method of discussing sale. Okay, I am just putting forward my method here, which I think is pretty easy to understand. You may listen to this and then make a decision that what exactly you want to follow. Okay, I'm just giving you one alternative way of understanding the sale concept in an easy manner. Okay, so in case I sell away a depreciable asset, you will first check, did my block become empty? Two things are possible. Either yes, block became empty, or no, block did not become empty. If my block became empty, then point number one, depreciation is possible. Yes or no? Block became empty. What depreciation? No depreciation. Block became empty means what? I had only one asset in the block. I had only plant A in the block. Only this one plant was there in the plant and machinery 15% block. And this plant itself I sold. So do I have any asset in the block now? No, this block has become empty. So now if the block becomes empty, is there any scope of depreciation? Obviously, then no depreciation. So if no depreciation, then only thing is either you will have STCG or you will have STCL. Okay, if your block became empty, then you will not have depreciation. You'll either have STCG or STCL, that's all. But if your block is not empty, we had in the plant and machinery 15% block, we had two plants. We had plant A and we had plant B. Plant A alone I sold. Is my block empty? No, I still have plant B. So if my block is not empty, you will first try depreciation. You will see, is depreciation possible? See, when will depreciation be possible? Depreciation will be possible only if this closing WDV number is positive. If this closing WDV number is negative, then will depreciation be possible? No. So you will first try for depreciation. If you are able to provide depreciation, great, end the story. If depreciation is not possible, then you will have STCG. So you will first try for depreciation. If depreciation is not possible, then you will do STCG calculation. I'll give you examples, don't worry. So what is my seventh concept here? What if I sell away my depreciable asset? If I sell away my depreciable asset, what will you check? Did my block become empty? Yes, my block became empty. Then no depreciation. You will have either STCG or you will have STCL. If my block is not empty, then first you will try for depreciation. If depreciation is not possible, then you will have STCG, story over. This you can blindly apply in every situation. No chance you will go wrong. I'll give you an example now. Listen to me very carefully. Let us say we had only one plant, plant A. Only one plant was there in my plant and machinery 15% block. Only one plant I had. My opening WDV of this block was 100 rupees. Add actual cost of assets acquired. We did not acquire any asset. Less monies payable with respect to assets sold. This plant A I sold during the year. I sold it for 80 rupees. Okay, so what is my monies payable number? 80 rupees. So what is our closing WDV, guys? Closing WDV will be 20. So I'll claim depreciation. Do you agree? Depreciation 15% I will claim. Do you agree? Bought? Yes. I'm trying to confuse you, even you are getting confused. Of course, no depreciation. I had only one plant and this one plant is sold, which means block has become empty. If block becomes empty, then will I have depreciation? I will not have depreciation. Understood? Yes. Who was it who said yes? Fida and Sona. Fida, you saying yes is not accepted. Okay, listen. So depreciation you will not have because block has become empty. So we will just have capital gains calculation. How to do capital gains calculation? Tell me. What is my full value consideration? 80. Then I don't have any expenses on transfer. I will straight away subtract cost of acquisition. Will I index the cost of acquisition? I will not, because depreciable asset, we can't index the cost of acquisition. And what will the cost of acquisition always be in such cases? Cost of acquisition for depreciable asset will always be opening WDV plus additions. So opening WDV plus additions, this will be the cost of acquisition. So what is the opening WDV plus addition? 100. So what's my net number? I have a loss of 20. This will be my STCL. Okay, now listen to my second situation. In my second situation, same thing, just that this time I sold my plant and machinery for not 80, I sold it for 180. Now what to do? So I will less monies payable 180. So what will my net number be? What will my closing WDV number be? Negative 80. Tell me, can I have a negative WDV number? Does it even make sense? No, I cannot have a negative closing WDV number. So what will I do? I will restrict this to 100 and I will restrict this to 0. Okay, guys, listen, always do block calculation first in the examination and then do capital gains calculation. Block has become empty, don't straight away do capital gains calculation. Examiner will expect both the calculations. Okay, show him negative, show him 0, show him WDV number here, and then do the capital gains calculation. Block has become empty, so will you have depreciation? You will not have depreciation. Straight away you will have capital gains. For how much did you sell away the asset? You sold it for 180. Cost of acquisition will be opening WDV plus additions. So I will have STCG of 80. Okay, now listen to my next situation. I have plant and machinery 15% block. In this block, I had two plants A and B. My opening WDV was, let us say, 100 rupees. Then add actual cost of assets acquired. I did not acquire any assets. Then less monies payable. This plant B alone, I sold. I sold it for 80 rupees. So money is payable 80. So what is my net number now? 20 rupees closing WDV. Now, can I claim depreciation? Can I claim depreciation? Yes. Has my block, see, follow the flow chart. I sold an asset. Did my block become empty? No, my block did not become empty. What will you always strive for? You will always first strive for depreciation. Closing WDV is positive. Is depreciation possible? Yes, depreciation is possible. So 20 into 15%, how much will that be? 20 into 15%, 3 rupees will be your depreciation. So 17 rupees, this will be your opening WDV. You will go ahead life as usual. This sale will not have any other effect, no capital gains calculation, nothing. Okay, but what if the same thing, plant and machinery 15% block, we have two plants A and B, B alone sold. This time also opening WDV 100, add actual cost of assets acquired, we did not acquire any, but money is payable, we sold that plant B for 180 rupees. Now, what is my net closing WDV? My closing WDV becomes a negative 80. Can closing WDV be negative? No. So I will restrict this to 0. I will restrict this to 100. Now tell me, I had two plants, A and B. Plant B alone sold. Did my block become empty? Block did not become empty. But so I will first try for depreciation. Is depreciation even possible? Closing WDV has become 0. Is the depreciation possible? No. So what will I try for then? I'll go for STCG. STCG calculation, what will my full value consideration be? I sold for 180. Less cost of acquisition. What will my cost of acquisition always be in depreciable cases? Opening WDV plus cost of acquisition, which will be 100. So 80 rupees. This will be our STCG. Perfect understanding. Yes, depreciable asset sold, 100% understanding. Depreciable asset sold, I've covered from PGBP perspective also, from capital gains perspective also. All right, guys. So whenever I sell away my depreciable asset, you can blindly follow this flowchart, no scope of going wrong. You will see, did the block become empty or not? If the block became empty, no depreciation. You'll either have STCG or you'll have STCL. But even though no depreciation, still for presentation's sake, show the WDV calculation. Okay, if block did not become empty, first try for depreciation. Only if depreciation is not possible, only then go for STCG. Okay, so this is it about my 7th point. Hari is asking what happens to plant A. Nothing happens. You forget about plant A. From tax perspective, you forget about plant A. Later, when plant A is sold, do nothing about it. That's all. Story is over about plant A. Okay, so this was it about my 7th discussion under depreciation. Now listen to my next concept under depreciation, additional depreciation. You tell me, what is additional depreciation also called? Additional depreciation is also called as accelerated depreciation. Now, extremely important. Listen very, very carefully. See, there are some concepts which you listen to with a little extra attention, right? No background music in your minds. Come on, sit up straight. You are not getting tired. Till I don't get tired, you are not allowed to get tired. Okay, we will go on and on till I don't get tired. Listen, what was I discussing about? Additional depreciation. Condition number 1, if you want additional depreciation, condition number 1, your assessee should either be manufacturer or assessee should be in the business of generation or transmission or distribution of power. Again, condition number 1, assessee should either be a manufacturer or generation, distribution, or generation, transmission, distribution of power. Even printing and publishing, even this is included under manufacturer. Then condition 2, what method of depreciation assessee should be following? Assessee should be following WDV method. If he's following SLM method, no concept of additional depreciation there. Condition number 3, assessee must have acquired an asset. Acquired what asset? Assessee must have acquired plant and machinery. Condition number 4, this plant and machinery should not be what and what. It should not be ships. Then it should not be aircraft. Then it should not be second-hand plant and machinery. Then it should not be plant and machinery which is used in office premises. Okay, it should not be plant and machinery which is used in residential houses. It should not be plant and machinery which is being used in guest houses. Then it should not be road transport vehicle. So we spoke about assessee. The first condition was assessee should be a manufacturer or assessee should be in the business of generation, transmission or distribution of power. Then we said assessee must be following the WDV method of depreciation. Then we said assessee must have acquired plant and machinery. Additional depreciation is only for plant and machinery. Plant and machinery should not be ships, should not be aircraft, should not be second-hand plant and machinery, should not be plant and machinery which is being used in the office premises or guest house or residential house. The plant and machinery should not be road transport vehicles. Also, plant and machinery should not be something which is already fully deducted. If it is already fully deducted in PGBP calculation, you will not get additional depreciation again. Now answer my question. My assessee has a factory. Okay, this factory is a huge factory. In this corner of the factory, assessee keeps raw material. In this corner of the factory, assessee does a manufacturing work. So every day, raw material has to be transported from here to here. For this purpose, not able to hear me? Is the audio a problem for everybody? Is it better now? Is it better now? I don't think it should be a problem because I didn't do any changes in the settings. It's the same thing only. Listen, so my assessee was doing manufacturing work, all right. And my assessee was having his raw materials in this part of the factory, whereas my assessee was doing the manufacturing work in this corner of the factory. So to do the transportation of the raw materials from this corner to this corner, my assessee was using a lorry. My assessee was using a truck. So on this truck, can my assessee claim additional depreciation? Yes or no? It is a vehicle, no doubt. It is a vehicle. It is a vehicle, but is it a road transport vehicle? It is a vehicle, but are we using it outside in the road? No. On this vehicle, we can claim additional depreciation. Did we understand this, guys? If my assessee is having a vehicle and the vehicle is being used inside the factory premises, then on this vehicle, we can claim depreciation. But if the same lorry is being used to transport goods from the warehouse to the showroom, then can we claim additional depreciation on that. Then on that we can't claim additional depreciation. You're understanding, guys? Road transport vehicle, now you understood this point properly. Road transport vehicle means you must be using the vehicle outside for transportation purposes. If you're going to use the vehicle inside the factory, within the factory, it will not be road transport vehicle. Okay, then how much if all these conditions are fulfilled, then you will get additional depreciation. At what rate will you get this additional depreciation? You will get additional depreciation at 20%. But in case the asset is put to use for less than 180 days, then how much will you get? In that case, you will get 10%, but no problem, balance 10% you will get when? In the next year, you can get the balance 10%. Okay, now how confident are you about additional depreciation? 100% confident? If 100% confident, let us see if you're able to answer this question of mine. Let us assume my assessee purchased plant and machinery, purchased it on 1st June 2021. My assessee put this plant and machinery to use, or it was acquired on 1st June 2021, but it was put to use on 1st January 2023. Now tell me, additional depreciation in which year you will get and what percentage will you get? Which year and what percentage? Additional depreciation. Why the silent treatment? See, what are our options? Our options are 21, 22 or 22, 23, right? In 21, 22, will we get any additional depreciation? No, because we did not even put it to use in 21, 22. So in 21, 22, we will not get additional depreciation. When are we putting the asset to use? Only in previous year, 22, 23. So in 22, 23, I will get additional depreciation. How much? I am putting it to use for less than 180 days, but still I will get full 20% additional depreciation. Why? Same thing. When do I look at 180 days? Same concept, guys. When do I look at 180 days? Only in the first year, only in the year of acquisition. Same concept. Now everybody understood, all those who made a mistake? Same concept even here. Subsequent year, you don't bother about, 180 days, less than 180 days and all. Subsequent year, even a few years you put the asset to use, you will get full 20% additional depreciation. Okay, now you answer my question. Let us say my asset is being put to use for less than 180 days. If it was, let us say in the first year, in the year of acquisition, put to use for less than 180 days. In that year, how much depreciation you will give me? Only 10%. Balance 10% you will get in the next year. This you should mention. You should mention in the answer paper that this should be a note that balance 10% can be claimed in the next year. This has to be written as a part of your answer. Okay, fine. So this was it about our discussion regarding additional depreciation. Now listen to the next concept relating to depreciation. In case you have depreciation, let us say 90 rupees, but your net profit is only 50 rupees. Because of depreciation, can you have a loss? Because of depreciation? No. Because of depreciation, you cannot have a loss. If your net profit is insufficient to absorb depreciation, then what will you call it? You will call it unabsorbed depreciation. This unabsorbed depreciation you can carry forward for how many years? You can carry it forward indefinitely. You can adjust it against which head of income? You can set it off against any income except salaries. You can adjust it against any income except salary, any income. Okay, can you adjust it against lottery income also then? No, against lottery winnings, casual winnings, you cannot adjust any loss. Even this you cannot adjust. Apart from lottery winnings, you cannot adjust unabsorbed depreciation against salaries also. Okay, now listen, if you have three things in front of you, you have current year depreciation in front of you, you have a current year loss from other business in front of you, you have brought forward business loss, and you have unabsorbed depreciation, which and you have net profit, huge net profit you have. Which of them will you give first priority? Which of them will you adjust first? You will always adjust current year depreciation first, then you will adjust current year losses from other businesses, then you will adjust brought forward business loss, only then you will adjust unabsorbed depreciation. Okay, guys, so this was it about our entire discussion regarding WDV depreciation. Now, coming to our last discussion under depreciation, the 10th discussion, SLM method. SLM method you will allow for whom? For which assessee will you allow SLM depreciation? Either the assessee should be in the business of generation of power, or he should be in the business of generation and distribution of power. To these assessees, you will allow SLM basis. For these assessees, is it mandatory that they have to follow SLM? No, it is optional. If it depends upon them, they can follow WDV or SLM. This option, when should they exercise? They should exercise in their first income tax return. Once they choose WDV, can they jump to SLM? Once they choose SLM, can they jump to WDV? No. Whatever you're going to apply, you will have to apply it. Whatever you're choosing, you will have to apply it forever. What if my assessee does not exercise an option? Then what will we assume? If he does not exercise an option, we will assume SLM. Okay, then in SLM also, do we have block method in SLM also? No, here no block method. Then in case the previous year in which you sold the asset is the same as the previous year in which you acquired the asset, it is SLM method. Okay, you acquired the asset same year itself, you sold the asset also. Now in this year, no depreciation, right? In case you sell the asset in the same year in which you acquired the asset, then you will not get depreciation. So SLM method is available for assessees who are in the business of generation and distribution of power. These assessees have an option. If they want, they can choose SLM, or if they want, they can choose WDV. Whatever they want to choose, they have to choose in their first income tax return. Once they've chosen, they cannot keep changing it every year. Once, in case they do not choose itself, we will assume they have chosen SLM. Here no block method, which means here every asset separately we will calculate. In case you sold the asset in the same year in which you acquired the asset, we purchased the asset today, tomorrow we sold the asset in the same year in which we acquired the asset, then no depreciation. All right, guys, now listen to my next discussion. I'll give you some examples. The biggest confusion in SLM basis is, what if you sell the asset? What if you sold the asset? Then what will happen? Listen to me. You already know the first point. You already know that in case the sale happens in the same year in which we acquired the asset, in that case, no depreciation. This point you already know. Second point, what if I sold the asset for a loss? I sold the asset for a loss means what? Sold the asset for a loss means my selling price is less than WDV. If I sold the asset for a loss means my selling price is less than WDV. Then what will you do with the loss number? What will you call the loss number? You will call the loss number as terminal depreciation. And what will you do with terminal depreciation? It will be allowed as a deduction just like any other depreciation. You will allow it. But what if I make a profit? Profit means what? Profit means my selling price is more than my WDV. In that case, what will you do? If my selling price is more than my WDV, then what will you call the profit? You will call the profit as balancing charge. And what will you do with this balancing charge? This balancing charge will be taxed just like any other business income. It will be taxed just like any other business income. It will be taxed as PGBP. All right. But in case I sold at a profit, sometimes capital gains is also possible. Shall we discuss that part? Till here, did you understand? Sometimes when I sell the asset, capital gains also is possible. Let us discuss that part. Let us take a situation. Let us say my WDV is 100 rupees, okay, and let us say my selling price is 80 rupees, okay, and the actual cost, long ago when I purchased the asset, I had purchased it for 120 rupees. This is my first situation. Now in this situation, tell me, what will you do? WDV is 100 rupees, I sold it for 80 rupees, actual cost is 120 rupees. What will you do here? In my first case, come on guys, answer. I sold it for 80 rupees. WDV is 100 rupees, which means I sold it at a loss. Yes. So what is the loss number? What's the difference? Selling price and WDV, the loss is 20 rupees. What will you call this loss? You will call this loss as terminal depreciation. This is my first situation. Okay. Then listen to my second situation. This time my WDV is 100. I sold it for 105 and my actual cost is 120. This time tell me, did I make a loss or did I make a profit? I definitely made a profit, right? I definitely made a profit. I sold it for 105 rupees, but my WDV is only 100 rupees. So what's my profit? My profit is 5 rupees. This 5 rupees you will tax it as what? This 5 rupees you will call it as balancing charge, and it will be taxed as PGBP. Okay, so terminal depreciation will be allowed. This balancing charge will be taxed. It will be taxed as what? It will be taxed as PGBP. Okay, now listen. Now listen, guys. My third situation, WDV is 100. My selling price is 150. My actual cost is 120. Here, tell me profit or loss. Profit or loss? Definitely I've made a profit. What is a profit? I sold for 150 rupees. WDV is only 100. So my profit is 50 rupees. Listen carefully now. Listen carefully. My profit is 50. But what is the speciality about the third situation? My selling price is even more than actual cost. My selling price is even more than actual cost. In such cases, this 50 I will split into two parts. Tell me, capital gains will be how much? By how much is it even more than actual cost? Actual cost is 120. I'm selling for 150, even more than actual cost 30. That will become capital gains. And the balancing figure will be balancing charge. What will the balancing charge be? 20. All right. So now you understood, guys. In case you sell in such a way, the selling price is even more than actual cost, then the difference over and above actual cost, whatever you have received, that will become capital gains, and the balance profit will be balancing charge. Crystal clear with this discussion also? Yes, guys, everybody understood. With this, we come to an end to our depreciation discussion finally. In depreciation discussion, we've learned totally 10 points. Our last point was about SLM. Okay, and one last point I will put under PGBP to stress upon it once again. What is the latest amendment? Goodwill on business, goodwill of business, goodwill of profession, not depreciable. This is something which you're already aware of. So we began our discussion with these basic points. Then we learned about depreciation. Under depreciation, we learned about the three conditions. Then we learned how to calculate depreciation. In the year of acquisition alone, you will check 180 days. Then we learned about WDV and SLM. We learned about the depreciation rates. We learned about all the steps. We learned what and all will be included in actual cost. We had a detailed discussion regarding the special situations. Some seven special situations we had learned. Then we learned what if I sell the depreciable asset. You will see whether block became empty or not. On that basis, you will make a decision. Then we learned about additional depreciation. Then we learned about unabsorbed depreciation. After unabsorbed depreciation, we spoke about SLM method. And then now finally, we spoke about goodwill of business or profession, not depreciable anymore. Shall I take you to the next adjustment, guys? Are we all thorough with this? Until here, we will not make any conceptual mistake, right? Yes. Now listen, guys, our next discussion is about scientific research. Scientific research, does any section number come to your mind? Scientific research, section 35. By the way, what was a what is a charging section for PGBP? Charging section is section 28. Okay, and depreciation, what is the section? Section 32. All right, now coming to scientific research, section 35. Section 35, scientific research can be two types of scientific research. We can either have in-house scientific research, or it can be a contribution which we are making to outsiders. In-house scientific research, it should be related to my assessee's business or profession, but contribution to outsider, this may be related to my assessee's business or profession. It may not be related to my assessee's business or profession, doesn't matter. But in-house scientific research should be related to my assessee's business or profession. If I do an in-house scientific research, I may incur two types of expenses. I may incur either revenue expenses or I may incur capital expenses. If I incur revenue expenses, I may incur revenue expenses before commencement of business, or I may incur revenue expenses after commencement of business. Now you tell me, before commencement of business, how many years will you look at? Only 3 years before commencement of business. And before commencement of businesses, what revenue expenses you will consider? Will you consider all revenue expenses? No, you will consider only two of them. Which two? You will consider only raw material, and you will consider salary to scientific research staff. And even in salary, what will you not consider? Even in salary, we will not consider perquisites. Okay, after commencement of business, we will consider any revenue expenditure. After commencement of business, here no condition. Here I will consider any revenue expenditure only before commencement of business. Only here I will consider only these two. Whether before commencement of business, whether after commencement of business, it should be relating to the assessee's business or profession. Then in case it is capital expenditure, even this capital expenditure may be before commencement of business or it may be after commencement of business, guys. If it is before commencement of business, then tell me how many years before commencement I will consider. Even here I will consider only 3 years before commencement of business. But whether before commencement, whether after commencement, what is the only capital asset which I do not consider? I will not consider land. Whether before commencement, whether after commencement, I will not consider land. Now, listen to my next point. Whether I put the asset to use or not, is that relevant under section 35? No. Always remember, guys, put to use is a concept which we will learn and we will keep only in depreciation. Whether section 35, whether 35 AD, whether preliminary expenses, whatever be the concept, we will not apply put to use. Put to use is a concept which we will apply only and only where? Put to use is a concept which we will apply only in depreciation. So in scientific research, in section 35, what is enough? It is enough that we acquired the asset. It is enough that we acquired the asset. If we acquired the asset, that itself will give us section 35 deduction. Now tell me, if I purchased a capital asset for scientific research and if I take section 35 deduction, same capital asset, can I claim depreciation also? I cannot claim depreciation. If I'm using that asset for section 35 deduction, then that same asset I cannot claim depreciation also. Then tell me, because of revenue expenditure, can I have a loss? Can I have a loss because of revenue expenditure? Yes. But because of capital expenditure, can I have a loss? No. Because of capital expenditure, if I have a loss, what will I call it? I will call it unabsorbed capex on scientific research, and I will treat it just like unabsorbed depreciation. But because of revenue expenditure, can I have a loss? Because of revenue expenditure, yes, I can have a loss. All right, guys, then let us say I purchased a capital asset. I purchased a capital asset for scientific research and I claimed section 35 deduction I claimed. Later, the same capital asset I sold. When I sell away the capital asset which I used for section 35, what will you check? You will check, did I put it to some other use or did I not put it to some other use? For example, I used it for scientific research for some years and then I'm starting to put it to some other use. See, when I start to put it into some other use, now it will enter the block. But it will enter the block at what value? It will enter the block at 0 value. I can't claim depreciation. It will enter the block. See, why will it enter the block? Because I'm going to start using it for business or profession, it will enter the block. But it will enter the block at 0 value. Why am I not giving any value? Because I have already claimed section 35 deduction. So I can't claim depreciation again. So that is why it will enter the block, but it will enter the block at 0 value. So later, when I sell the asset, any asset in block, whenever you sell any asset in block, what do you do with it? You call it monies payable for asset sold. You subtract the selling price. Same treatment you will do even over here. But what if you did not put it to any other use? What if straight away you sold it without putting it to any other use? Then in that case, two things. Thing number one, whatever is the selling price or whatever section 35 deduction you claimed already, whichever is lesser, what will you do? Whichever is lesser will go to your PGBP taxation. It will be taxed under PGBP. And number two, you will have capital gains also. What will your capital gains number be? The selling price minus the cost price will become your capital gains number. Okay, so this was our section 35 in-house discussion. In case I am making any contribution towards scientific research, it may either be, come on guys, let us revise the entire thing. In case I do any contribution towards scientific research, section 35 will apply. Under section 35, it may either be in-house scientific research or it may be a contribution to outsiders. If it is an in-house scientific research, then I may incur revenue expenses or I may incur capital expenses. If I incur revenue expenses or if I incur capital expenses, if it is before commencement of business, I will look at only 3 years before commencement of business, right? And in case it is revenue expenses before commencement of business, revenue expenses before commencement of business, only two of them I will consider. Number one, raw material. Number two, salary which I pay to scientific research staff. And even in the salary, I will not consider perquisites. All right. Then we started learning about capex, whether before commencement, whether after commencement, I will not consider land, I will exclude land. This in-house scientific research should definitely be related to my assessee's business or profession. Only and only then I will consider. Then we learned whether I put the asset to use or not. It is irrelevant. Put to use is a concept which I restrict only to depreciation. Once I acquire the asset, that itself is enough. I will get section 35 deduction. Then we learned if you are going to claim section 35 deduction, same asset you cannot claim depreciation also. Then we learned because of revenue expenses, you can have a loss. But because of capital expenses, you cannot have a loss. If my net profit is not sufficient to absorb the capital expense, what will we call it? We will call it unabsorbed capex on scientific research, which will be treated just like how we treat unabsorbed depreciation. Then we learned in case my capital asset, which is used for scientific research, I sold the capital asset, then what will you do? In case I sold the capital asset, you will check, did I put it to some other use and then sold it? As soon as I put it to some other use, it will enter the block. Did you guys understand this? Come on, let us look at this once again. Okay, let's go a little slowly and let us look at this part once again. When I sell the capital asset, what will you do? When I sell away the capital asset which I was using for scientific research, you will check, did I directly sell it away or did I put it to some other use and then sold it away? If I put it to some other use, if I'm going to use it for business or profession, now it will enter the block. It will enter the block, but at what value? It will enter the block at zero value. Why will it enter at zero value? Because I cannot claim depreciation on it. Why can't I claim depreciation on it? Because entire amount already section 35 I have enjoyed. So I can't claim double benefit. I can't claim depreciation again. So I will let it enter the block, but zero value. Later, whenever I sell the asset, now it becomes just like any other business asset. Any business asset I sell, any depreciable asset I sell, what do? Less money is payable from asset sold. You subtract in the block calculation. Same thing, you will treat it just like money is payable. But what if I put the asset to some other use? What if I put the asset for some other use, guys? Then what if I don't put it to some other use? If I don't put it to some other use, and if I directly sell it, then you will see what was section 35 deduction I claimed already. That number or the selling price number, whichever is lesser, will be taxed as PGBP. Whatever was my selling price number or whatever was the section 35 deduction I claimed long ago, whichever is lesser will be taxed as PGBP. And the difference between selling price and cost price will also go to capital gains. Did you all understand this part? Give me a quick response, please. Yes. Now I'll go to one last point under section 35. What if I make a contribution to outsider? To whom can I make a contribution? Who and all is covered here? Let us discuss this part. Contribution to outsider. For example, I can contribute to an approved university, or I can contribute to an approved college, or I can contribute to an approved national laboratory, or I can contribute to an approved research association, or I can contribute to IIT. I can contribute to all of them for scientific research. Then I can also contribute to these people for research in social science. Then I can also contribute to these people for research in statistical science, statistical research. Or I can also make a contribution to an Indian scientific research company. What is an Indian scientific research company? It's a company, if you look at this company's MOA, if you look at the company's object clause, what will be written in the object clause? Scientific research. So when I make a contribution to outsiders, this contribution may be related to my assessee's business, may not be related to my assessee's business, doesn't matter. But to whom am I making the contribution? I may make a contribution to an approved university, approved college, approved national laboratory, approved research association, approved IIT for scientific research, or for research in social science, or for statistical research. Or I may also make a contribution to an Indian scientific research company whose MOA, object clause, if you see, main object would be written as scientific research. All right, so this is it about our discussion regarding section 35. This was our second adjustment, section 35. All right, now let me take you to the third adjustment. After this, we're going to be learning about assessees who are carrying on specified business. Does any section come to your mind, guys? Specified business, section number 35AD. Section 35AD. What if my assessee is doing specified business? Specified business means what? Like cold chain facility or warehousing facility for storing agricultural produce, or warehousing facility for storing sugar, or any hospital with at least how many beds? Hospital with at least 100 beds. Hotel what category? Minimum how many stars? Hotel minimum 2 stars, 2 star or above, not 3, 2 stars or above. Okay, or a housing project, or producing fertilizers, or manufacturing honey, or producing beeswax. All this will come under specified businesses. Now these specified businesses, whatever capital expenditure they incur, even that capital expenditure will be allowed as a deduction under section 35AD. Now what is important here? New capital asset acquired is important or put to use is important? Tell me. 35AD deduction, when will you give me? Will you give me the deduction when I acquire the capital asset, or will you give me the deduction when I put the asset to use? I told you, put to use is a concept which you keep only in depreciation. As soon as I acquire the asset, you will give me a deduction, right? Now, even over here, the expense may be incurred before commencement, or it may be incurred after commencement. If I incurred before commencement, tell me how many years before commencement? Do we have any time limit here? Here we do not have any time limit. It can be any time before commencement of business. But then listen guys, whenever you talk about 35AD, whenever you talk about capital expenditure, this capital expenditure should be fully connected to this specified business. This capital expenditure should be wholly for the purpose of the specified business. In case you're incurring the expenditure before commencement of business, then it should be capitalized in the books of accounts. Capitalized in the books of accounts when? It should be capitalized in the books of accounts when you commence business. See, sometimes what happens is before commencement of business, you might have incurred revenue expenditure. Even that revenue expenditure, I will allow as a deduction if it is capitalized in the books of accounts. So in any expenditure you incur before commencement, before commencement, revenue expenditure, capital expenditure, any expenditure relating to this business, if you incur before commencement of business, if it is capitalized in the books of accounts when you commence your business, I will allow it as a deduction. Then if you want 35AD, what is mandatory? If you want 35AD, audit of books of accounts will be mandatory. Now tell me, under 35AD, what are the 3 assets for which section 35AD deduction you do not get? What are the 3 assets for which 35AD you do not get? Number 1, land. Number 2, goodwill. Number 2, financial instruments. Now you tell me, what is the correct way of writing the second point? Should I write goodwill or should I write intangible assets? What is the correct way of writing the second point? Should I write goodwill or should I write intangible assets? I should write goodwill only. I should not write intangible assets, because I am not excluding all intangible assets. I am excluding only and only goodwill. Okay, then if I'm claiming 35AD, from 35AD business, if I have any loss, let me draw a chart for you. Let us say I have 4 businesses. I have a specified business. I have a 35AD specified business from which I earned income. I have non-35AD business from which also I earned income. Then let us say I have another 35AD business from which I incurred a loss, and I have another non-35AD business from which I incurred loss. Now tell me, 35AD business loss, can I adjust against 35AD business income? Yes. 35AD business loss, can I adjust against non-35AD business income? No. Then tell me, non-35AD business loss, can I adjust against 35AD business income? Yes. Non-35AD business loss, can I adjust against non-35AD business income? Yes. Okay. Then tell me, if I have loss from 35AD business, then how many years can I carry it forward for? I can carry it forward for how many years? I can carry it forward indefinitely. Now listen guys, I'm going to make an extremely important point, a point which a lot of students make a mistake. Unabsorbed depreciation and section 35AD business loss. What is the common point between both? What is the common point between both? Even this can be carried forward indefinitely. Even this can be carried forward indefinitely. Is there any other common point between both? No, there's only one common point. Generally, what happens is students start treating 35 AD business loss just like unabsorbed depreciation just because both are indefinitely. There's a huge difference between both. Unabsorbed depreciation you can set off against what? You can set off against what? Against any income except salary. But 35 AD business loss you can set off against what? You can set off against only section 35 AD business income. You're understanding, guys? Do not make a mistake here. Okay, both can be carried forward indefinitely, no doubt, but there is a huge difference. Unabsorbed depreciation I can set off against any income except salaries, but 35 AD business loss I can set off only against 35 AD business income. Now listen, I have hotels. I have two hotels, Hotel 1 and Hotel 2. Okay, Hotel 2 is a 2-star hotel. Even Hotel 1 is a 2-star hotel. But Hotel 1, this hotel was established long ago. It was established even before 35 AD came into the picture. So that is why for Hotel 1, 35 AD deduction I was not allowed to take. But this Hotel 2 is a new hotel. For this hotel, 35 AD deduction I am allowed to take. Okay, now this Hotel 2, I incurred a business loss. This Hotel 1, I have business income. Can I set off this business loss against this business income? Yes or no? Come on, guys, tell me. Yes, this is allowed. Why? Because Hotel 2 is a specified business. Even Hotel 1 is specified business. Just that Hotel 1 3580 deduction I am not claiming. But even Hotel 1 2-star or above, even Hotel 2 2-star or above, both are specified businesses. So specified business loss I can adjust against specified business income. It is not a precondition that even this business should be claiming 3580 deduction. That is not a precondition. Precondition is that this should be specified business. Even this should be specified business. Understood this point also, guys? Yes. Now listen to my next point. Under 35 AD, we are still under 35 AD. We have a few more points under 35 AD. Listen, in case I am making payment, I incurred a capital expenditure. For this capital expenditure, I am making a payment. This payment is more than 10,000 rupees. I am paying to a single person. I am paying against a single invoice. I am paying on a single day. What will you suggest to me? How should this payment be made? You will suggest to me that this payment should be made, if more than 10,000, you will suggest it should be made in specified mode, right? See, guys, non-cash mode, entire PGBP, everywhere, what do we say? Specified mode. There is only one place where we use the word non-cash mode. I will teach you. Non-cash mode we use a lot of times in which chapter? In chapter 6A. Chapter 6A, ATB. Chapter 6A, you see so many places, ATGGB, ATGGC, so many places you see non-cash mode. That is chapter 6A. But in PGBP, everywhere we say specified mode. Only one place we say non-specified mode, which I will discuss with you later. Only one place we say non-cash mode. Everywhere else we say specified mode. Okay, so this payment has to be made in specified mode. Only then I will get a deduction. But if this payment is made in non-specified mode, then sorry, I will not get a deduction. All right, guys, is this concept clear, everybody? Yes, so we are learning about section 35 AD. Now listen to my next discussion. This 35 AD business, can it have second-hand plant and machinery? I will see what is second-hand plant and machinery divided by my total plant and machinery into 100. This percentage should be how much? My second-hand plant and machinery divided by total plant and machinery into 100, this should be less than or equal to 20%. In simple words, in this specified business, second-hand plant and machinery should not be more than 20% of total plant and machinery. It should be less than or equal to 20%. Now listen, my total plant and machinery will be what? Total plant and machinery will be new plant and machinery plus second-hand plant and machinery. So second-hand plant and machinery divided by total plant and machinery should not be more than 20%. Now answer my question. I am comparing two things. Listen carefully. I am comparing two things, additional depreciation and section 35 AD. Why am I comparing these two? Because even here we talk about second hand. Here second hand plant and machinery not allowed. Even here we're talking about second hand. My question is, what is second hand plant and machinery? If it is Indian second hand plant and machinery, will it be considered as second hand? Yes. If it is imported second hand plant and machinery, will it be considered as second hand? Yes. What is imported? Imported means what? It was used in some other country before. For India, it is new. It was used earlier already. It is second hand, but it was used earlier where? Outside India. And from there, I am bringing it into India. In India, it is never used before. So for India, it will be treated as new plant and machinery. No, it is imported second hand. I will treat it as second hand only. But under 35 AD, the answer will be a little different. Under 35 AD, Indian second hand will be second hand, but imported second hand will be treated as new plant and machinery. Under section 35 AD, if it is imported second hand, will you put it in the numerator? No, imported second hand will be treated as new plant and machinery. Now answer my question. What if the second hand plant and machinery by total plant and machinery is more than 20%? Then what will happen? If it is more than 20%, then what will happen? If it is going to be more than 20%, then it will not be treated as specified business. If it is going to be more than 30%, then 35 AD itself will be ineligible for that particular business. If it is more than 20%, then it will be treated as if this business itself is not a specified business. If it is more than 20%, that entire business itself, no 35 AD deduction. Understanding? This was my entire discussion regarding section 35 AD. We have one more point under 35 AD. I'll come to that. In fact, two more points we have. Shall we do a quick revision of all the points we've learned? Yes, scientific research, section 35. Are you all clear? Yes, one by one, the students have started leaving. We began the session with 225. Now, one by one, you're all starting to leave, getting tired. Guys, come on, you cannot afford to get tired. If this is how it's going to be, I'm going to make sure that you don't get recordings. Listen, guys, you got to pay attention. An important discussion is happening here. All right. If you're going to leave thinking I'll watch the recording later, trust me, it will not happen. Okay, so bring in that basic self-discipline. No doubt you might be very tired by now. It's fine. It's fine. You might be very tired by now. It's okay. Now is not the time to give up. Okay, we do not know the spelling of tired till we finish off the examination. Till then, how much ever hard work you make us do, we will do. That should be your attitude. All right, come on, guys. Section 35, one quick revision. Scientific research may be in-house scientific research or contribution to outsiders. All right, in-house scientific research is going to be a REVIX or it can be CAPEX. All right, it can be REVIX or it can be CAPEX. If it is revenue expenditure, if it is before commencement of business, I will consider only last 3 years before commencement of business. But if it is in-house scientific research, it has to be related to the business of the assessee. Under section 35, the only asset I exclude is land. Under section 35, the only asset I exclude is land. If I make a contribution to outsider, this may be related to my assessee's business, may not be related to my assessee's business, does not matter. Then we learned under section 35, it is important that you acquire the asset, whether you put it to use or not, doesn't matter. Then we learned because of CAPEX, you can't have a loss. Because of CAPEX, if you have a loss, we will call it as unabsorbed CAPEX on scientific research. Then we learned in case after purchasing an asset for scientific research, if I sell away the asset, then what will you check? This was important. After purchasing the asset for scientific research, after claiming 35 deduction, if I sell away the asset, you will check, did we put the asset to any other use, or without putting it to any other use, straight away we sold it off. If we put it to some other use, then we will let it enter the block, but we will let it enter the block only at zero value. Okay. In case we later sell away the asset, it will be treated just like any other depreciable asset. Any other depreciable asset you sell, what do? you put it under monies payable. In case I sell the asset without putting it into any other use, if I don't put it into any other use, then the selling price or section 35 deduction, whichever is lesser, will be taxed as PGBP. Also, the difference will go to capital gains. Okay, now coming to the next discussion, Shahid is asking, after weighted deductions are removed, quoting subsection 35 is important, not required, Shahid. You can just call it as deduction under section 35. Okay, now coming to the next discussion, section 35 AD discussion. Under 35 AD, my assessee is having a specified business. Listen carefully. I'm giving you a quick revision of the entire thing once again. Under section 35 AD, for specified business, if my assessee incurs capital expenditure which is relating to the specified business, and if this capital expenditure is not land, not goodwill, not financial instruments, this capital expenditure I will allow as a deduction. I will allow as a deduction as soon as you incurred this expenditure. Whether you put it to use or not doesn't matter. Even here we allow pre-commencement expenses, but pre-commencement expenses we don't have any period here. For pre-commencement expenses we have only one condition, and that is it should be capitalized in the books of accounts. This is something which you should write in your answer paper. In case you have pre-commencement expenses, you should write in your answer paper that it should be capitalized in the books of accounts. Okay, then we learned audit is mandatory, and then we learned in case I have 35 AD business loss, this I can adjust only against 35 AD business income. 35 AD business loss I can carry it forward indefinitely, but the biggest difference between unabsorbed depreciation and 35 AD business losses, both can be carried forward indefinitely, but unabsorbed depreciation can be set off against any income except salaries, whereas 35 AD business loss can be set off only against 35 AD business income. Then we learned that in case I have two hotels, if I have two specified businesses, and if even though for the specified business I am not claiming 35 AD deduction, still this business loss I can set off here. What is important is specified business loss to be adjusted against specified business income. It is not necessary that even this business should be claiming 35 AD deduction. At this stage, tell me, from warehousing business I have a loss, okay? From cold storage business I have an income. Can I set this off? Yes, it is not necessary it should be same specified business. It can be any specified business. You know what the law says? Specified business loss can be set off against any specified business income. All right, so it is not necessary it should be the same. Then we learned even here more than 10,000 make the payment in specified mode. Then this was the point where some of us might have gotten a little bit confused. So this part I'll go once again a little bit slowly this time, try to absorb. Okay, see, we will see how much second-hand plant and machinery we have. The second-hand plant and machinery should not be more than 20% of total plant and machinery. So second-hand plant and machinery divided by total plant and machinery. Total plant and machinery means what? New plus second-hand, everything put together. So second-hand plant and machinery divided by total plant and machinery should not be more than 20%. It should be up to 20%. Even equal to 20% chalta hai. It can't be more than 20%. It has to be up to 20%. Okay, now when I say second-hand plant and machinery, for 35 AD, imported second-hand will be considered as new plant and machinery only. Under additional depreciation, imported second-hand also will be considered as second-hand, which means under additional depreciation, Indian second-hand is anyway second-hand, no additional depreciation. Imported second-hand will also be considered as second-hand. Even here, no additional depreciation. But under 35 AD, Indian second-hand will be second-hand category, but imported second-hand means what? It was earlier used in some other foreign country. It was never used in India. For India, it is new. That is imported second-hand. Imported second-hand for 35 AD will be considered as new plant and machinery only. Now, did we all understand the second-hand plant and machinery point, guys? Everybody, Jacob, did you understand this part now? Yes, so in case it is imported second-hand, it's actually second-hand. Actually, somebody else has used it, okay? But for 35 AD, I will treat it as new. All right, now listen to my next discussion, guys. Under 35 AD itself, we have two more points. The point is, if my business is a cold storage facility, is it mandatory that I have to claim 35 AD deduction, or is 35 AD deduction optional? What do you think? It is not mandatory, it is optional. If you want, you can claim 35 AD. It's not mandatory. Then tell me, I purchased a capital asset, okay? I claimed 35 AD deduction. Same capital asset, can I claim depreciation also? No, 35 AD or depreciation, choose. You can't take both and all. Okay, now listen, last point under 35 AD. I purchased a capital asset. I claimed 35 AD deduction. I must use this capital asset for specified business for how many years minimum? I must use this asset for specified business for minimum 8 years. What if I do a violation here? What if I do a violation here? That is, what if in less than 8 years itself, I start using it for some other purpose? In less than 8 years itself, if I start using it for some other purpose, then it will enter the block. It will enter the block, but it will enter the block at what value? What will be the actual cost for it to enter the block? We will see what was the 35 AD deduction that you had claimed already. From this, we will imagine that you had enjoyed depreciation already. Nothing, but I can call it as deemed depreciation, guys. Yes, this balance number will enter the block. Then this same number will also be taxed as PGBP. So this same number will be added to your block also. The same number will be taxed as PGBP also. Which number? 35 AD deduction minus deemed depreciation. 35 AD deduction minus deemed depreciation. The same number will be added to your block also. The same number will be taxed under PGBP also. Okay, then one more violation is possible. What if I did not put it to some other use? What if I straight away sold it? Then what will happen? Straight away sold it. Then whatever is a selling price, that will be taxed as PGBP. That's all. Okay. So here the most important point is this first violation. What if I start using it for some other purpose? I am supposed to use it for specified business for 8 years. But what if in these 8 years, I start using it for some other purpose? You will see what is the 35 AD deduction which I enjoyed already. From the 35 AD deduction, you will subtract deemed depreciation. You will imagine I had claimed depreciation all these years. What will be the number? This number will be added to the block as actual cost. On this number, you will now claim depreciation. Also, this number will be taxed as PGBP. Understood. So with this, we finally come to an end to our 35 AD discussion. All right. So remember the violation. I'm supposed to use this asset for specified business for 8 years. In this 8 years, if I start using it for some other purpose, I will see how much deduction I had claimed already. From that, I will subtract deemed depreciation. I'll imagine there was depreciation enjoyed all these years. This net number will be added to the block, and the same net number will be taxed as PGBP also. Okay, shall I take you to the next discussion now, guys? This was our adjustment number 3. Until now, what are the section numbers we've learned? We've come across section 28, our charging section. See, we don't have to remember every section number, okay? I'm talking about just the important ones, which would be nice if we are able to remember. Okay, section 32, we spoke about depreciation. Section 35, we spoke about scientific research. And section 35 AD, we spoke about specified businesses. Now I'm coming to our next section, section 35D, which talks about preliminary expenses. I really don't know why, but a lot of times students give a lot of stepmotherly kind of a treatment to section 35D. It has a lot of things to remember. It has a lot of things which you should know. So no compromise will happen here. Listen, I'll take you through the points one by one. Under section 35D, preliminary expenses. Now, preliminary expenses means what are the expenses? When did you incur the expenses? Two options. Either you incurred the expense before the commencement of business, or you may have incurred the expense after commencement of business. If you incurred the expense after commencement of business, why did you incur the expense? You incurred the expense either because you wanted to extend your existing undertaking or because you wanted to set up a new unit. Okay, when did you? So first of all, timing. When did you incur the expense? You incurred the expense either before commencement of business, that is typical preliminary expense, or you incurred the expense after commencement of business. For example, I have a paper manufacturing factory. This factory can manufacture 100 rolls of paper every day. I wanted to expand the capacity of this factory. I wanted to manufacture 200 rolls of paper every day. That is extension. I wanted to expand the capacity of this factory. Or I incurred the expense because I wanted to set up a new unit. I wanted to set up one more paper manufacturing unit. So for this, I'm incurring expenses. But what kind of expense? Will we cover every expense? No. We have two buckets, guys. Two buckets I will be discussing the expenses with you. In the first bucket, I have expenses relating to preparation of feasibility report. I have expenses relating to preparation of project report. I have expenses relating to preparation of market or conducting market survey, and I have expenses relating to doing some engineering services. These expenses in the first bucket, I have 4 expenses. These expenses should be incurred by whom? These activities should be done by whom? Either by an assessee, or these activities should be done by some approved concern. All right. In the second bucket, I have which expenses? Second bucket, I have a lot of general expenses. For example, legal expenses that you've incurred to get MOA prepared, to get the AOA prepared, then whatever expenses you've incurred for incorporation of the company, then you wanted to make a public issue, you wanted to set up a new unit. No, for that you needed money, so you decided to do an IPO. So whatever public issue expenses you've incurred, for example, you would have paid the underwriters, you've paid some commission, then you would have incurred expenses to prepare the prospectus. All these expenses, it doesn't matter who is incurring, it doesn't matter who is doing the activity. It may be the assessee, it may be an approved concern, it may also be an unapproved concern. Okay, so when are you incurring the expenses, guys? Come on, sit up straight. You are not getting tired already. When are you incurring the expenses? You're incurring the expenses before the commencement of business, or you're incurring after the commencement of business. Why? For extension or to set up a new unit. What expenses are you incurring? It may either be first bucket or second bucket. In the first bucket, it should be incurred only by the assessee or approved concern. Second bucket, it may be incurred by assessee, approved concern, unapproved concern, anybody, doesn't matter. What are the expenses in my first bucket? We have the feasibility report, we have the project report, we have the market survey, and engineering services. Second bucket, what are the expenses we have? Legal expenses to prepare the MOA, to prepare the AOA, to prepare agreements, incorporation expenses, public issue expenses, prospectus preparation expenses. All these are the expenses covered under 35D. Then whatever you incur, will I allow entirely, fully? No, we have a maximum limit. We have a maximum limit. You will see what is the maximum limit. You will see what is the actual expense. Out of these two, you will pick whichever is lesser. That whichever is lesser number, you will divide by how many years? This whichever is lesser number, you will divide by 5 years, and you will allow this deduction across 5 years. Okay, so we have a maximum limit. Now, what is this maximum limit? Let us try to understand what is a maximum limit. Maximum limit depends upon who is the assessee. It depends upon, is the assessee a company, or is the assessee any other assessee? If it is a company, you will calculate two things. Number one, tell me what is the first thing? Cost of project. Cost of project would be nothing but your fixed assets, your land, your building, your plant and machinery, your furniture and fixtures, all that. Then you will see what is the capital employed. Capital employed means what? Capital employed means issued share capital plus debentures plus long-term borrowings. Guys, listen. Stop whatever you're doing and listen. Issued share capital, not paid up share capital, issued share capital. Special point over here, we're talking about issued share capital and not paid up share capital. Okay, come on now. So if it's a company, what are the things you will compare? Cost of project and capital employed. Out of these two numbers, you will pick whichever is higher. And out of that higher number, what percentage will you take? You will take 5% of that higher number. Okay, if it is any other assessee, only one thing you will calculate. And what will that one thing be? Cost of project. Of that cost of project, what percentage will you take? 5% you will take. Got it? This is section 35D. So section 35D, always learn this in 3 buckets: when, what, and how much. When did you incur the expense? You either incurred the expense before commencement of business, or you incurred the expense after commencement of business for extension or to set up a new unit. Then what expense did you incur? Feasibility report, project report, market survey, engineering services, and all. These 4 should be done by the assessee or any approved concern. All right. Then these expenses can be done by anybody, can be done by assessee or any approved concern or any unapproved concern. Then we learned there is a maximum limit. You will compare the maximum limit with the actual expenditure. Out of these two, you will pick whichever is lesser. You will divide it by 5, and this much you will allow across 5 years. What is the maximum limit? Maximum limit depends upon whether it is an Indian company or whether it is any other resident assessee. If it's an Indian company, you will compare cost of project with capital employed, and out of these two numbers, you will pick whichever is higher and 5% of that. Capital employed, please remember the meaning of capital employed. It is issued share capital plus debentures plus long-term borrowings. Okay. Other assessee, straight away just cost of project into 5%. That's going to be your maximum limit. Crystal clear with this discussion also, guys? This was section 35D. Okay, shall I take you to the next discussion now? All right, the next discussion, let us go to the next part, the 5th concept, the next concept. I'm talking about interest. Interest on loan. See, your assessee may have borrowed interest on loan. This loan should be for what purpose? This loan should be for the purpose of business or profession. My assessee should have borrowed the loan for the purpose of business or profession. Then on this loan, whatever interest is incurred, that interest will be allowed as a reduction in the computation of PGBP. Now answer my next question. What if I borrowed a loan to acquire a capital asset? Then till you put the asset to use, till then you will put the interest into the actual cost itself. And after you put the asset to use, only after you put the asset to use, whatever depreciate, whatever interest you pay, only that will be allowed in the PGBP calculation. Till you put the asset to use, till then whatever interest you are paying, you will add it to the actual cost. Okay, then let us take a situation. My assessee is a company. My company wanted to pay dividend. To pay dividend, it did not have liquid cash. So company borrowed a loan from a lender. Why did the company borrow the loan? Because it wanted to pay dividend. Okay. Now on this loan, the company is going to pay interest. This interest, will it be allowed or not allowed? You borrowed a loan to pay dividend. This interest will be allowed or will be not allowed? This interest will be allowed. Then listen to my next point. My assessee, this time my assessee borrowed a loan. He borrowed a loan from a lender. Why did he borrow the loan? Because he wanted money to pay income tax. On this loan, he is paying interest. This interest, will it be allowed or will it be disallowed? This interest will be disallowed. Why will it be disallowed? Because when you're paying income tax, this becomes what purpose? This becomes personal purpose. It's as if you're borrowing a loan for a personal purpose. You paying income tax. Income tax is a personal expenditure. So whenever you borrow a loan to pay income tax, it's as if you've borrowed a loan for personal purposes, and this will be disallowed. Okay, now listen to my next point. My assessee is paying interest. My assessee is paying interest because my assessee paid income tax late. My assessee is also paying interest because my assessee paid GST late. So interest paid late relating to income tax. This is going to be penal in nature, allowed, disallowed. This will be disallowed. It's as if it's a penalty. But interest relating to GST, this will be compensatory in nature and this will be allowed. Okay, see, we're talking about penalties here, right? Whenever you pay any penalty, if you pay any penalty for non-compliance of law, what do you do with the penalty? You disallow the penalty. But in case you incur any penalty for non-compliance of some contract, then also do you disallow? No, then it will be allowed. See, this is a point which is even tested in your RTP, November 2022 RTP. I'm not sure if you've seen the video. I've uploaded that video as well for November 2022 RTP. This particular point is tested even in that. This, according to me, is pretty important. You're paying a penalty, okay? See, I'll repeat again if you did not understand. You're paying a penalty. Why did you pay a penalty? Because you did not fulfill the law. That penalty will be disallowed. But you're paying a penalty because you did not fulfill a contract. So you entered into a contract with me. You did not fulfill your promise under the contract. So you're paying penalty to me. This will be allowed. Penalty will be disallowed only if it is because of non-compliance of law. Did you understand this? Okay. Now listen to my next point. Listen to my next situation. Mr. Mukesh Ambani, he has a lot of money in his hands. He still went to the banker. He borrowed a loan from the banker. He used this loan for his business or his profession, and he's paying interest to the banker. This interest, he's saying it's my business expense. He's claiming it as a deduction. Because of this deduction, what's happening is his profit is becoming lesser and his tax is becoming lesser. Can income tax officer tell Mukesh Ambani, why did you borrow loan? You have enough money, no, you can use that money. Because you unnecessarily borrowed loan, unnecessarily expenditure you are having, unnecessarily your profit is becoming less, unnecessarily they are getting lesser tax from you. Why did you borrow loan? You could have used your own money. Can the income tax department question Mukesh Ambani like that? No. It depends upon the assessee, whether the assessee wants to use his own money or whether the assessee wants to borrow money and use borrowed money. That is his decision. The income tax officer cannot interfere with this. All right, guys, now listen to a very, very important point which I am making now. What is the meaning of interest? Section 2 of your Income Tax Act does define interest. And in the definition of interest, even processing fees. See, whenever you borrow a loan, you have to pay some processing fees. You have to pay some commission sometimes. You have to pay some brokerage sometimes to get a loan from a bank. Even that processing fee is included in interest definition under Income Tax Act. All right. So interest includes even processing fee. Interest includes even service fee and all which you have to pay to borrow the loan. But listen, under IFHP, section 24, here interest deduction you enjoy. Under IFHP section 24, you enjoy interest deduction, right? This interest deduction will not include processing fee. Understood? This interest deduction will not include processing fee. Section 24B. This interest deduction under IFHP will not include processing fee, but under income tax, under the PGBP part, wherever you see interest, there I will include even processing fee and service fee. This might be a new learning for some of you. All right, so this is it about my entire discussion regarding interest. One quick revision. Come on, guys. This interest should be relating to the business or profession of the assessee. Then it will be allowed as a deduction. If the company is borrowing interest to pay dividend, even this will be allowed as a deduction. But if assessee is borrowing a loan to pay income tax, now interest on this loan will not be allowed as a deduction. Then if the assessee is paying interest relating to income tax, it will be penal in nature, it will be disallowed. But interest relating to GST is going to be compensatory in nature and it will be allowed. We have a lot of court decisions supporting this point. Then we learned that why are you borrowing the loan? Income tax department cannot question that. And then we said interest includes even processing fees and service fees. Okay, so this was our discussion regarding interest. Now listen to our next discussion. We're going to be talking about employers' contributions. Now this is something which is very easy and at the same time important. Listen, in case my employer is contributing towards provident fund, okay, now see, for the employee it's going to be an income 12%, all that you will be doing. That's from the employee's perspective. But here my assessee, who is my assessee for this discussion? My assessee is the employer. For the employer it's an expense, guys. For the employer, this expense will be allowed as a deduction. It will be allowed only if it is recognized provident fund. Similarly, my employer is making a contribution towards superannuation fund for the employee's benefit. Again, it's an expense for the employer. It will be allowed for the employer, but it will be allowed only if it is an approved superannuation fund. Okay, then assessee employer is contributing towards national pension scheme for the employee. National pension scheme under chapter 6A, tell me which section comes to your mind? Section Very good. Section 80 CCD. Employer is contributing towards 80 CCD NPS. Again, it is an expenditure for the employer. It will be allowed, but this will be allowed only up to 10%. Up to 10% of what? Up to 10% of salary of employee. For NPS purposes, salary means what? Whether 80 CCD calculation, whether PGBP calculation. For NPS, salary means what? Basic salary plus DA, which is forming part. DA, which is a part of the terms of employment. All right, then my employer is contributing towards gratuity fund. For the employer, it is an expense. It's an expense for the employer. For the employer, it will be allowed, but it should be what kind of a fund? It should be an approved gratuity fund. All right, now listen to my next point. Under the same sixth point, one more point. This time my employer is not contributing to gratuity fund and all. Employee is retiring. At the time of retirement, employer is directly paying to gratuity to the employee. See, gratuity fund means what? Gratuity fund means employer is getting tensed. Employer is getting worried. Suddenly, what if the employee retires? I have to pay gratuity to the employee. Suddenly, from where will I arrange so much money? So every year, little money, I will keep saving in one gratuity fund. Whenever employee retires, from the gratuity fund, I will take money and I will give to the employee. But is gratuity fund mandatory? No. So what if my employer is not saving money like this? Employer is saying, let's see. Later, whenever the employee retires, that time I'll somehow arrange money. So when employee is retiring, employer is immediately arranging money and paying gratuity to the employee directly, no fund and all. So what about this gratuity? Will you allow or will you disallow? This gratuity will be allowed. See, this gratuity, will section 43B apply to this gratuity? No. 43B applies to gratuity only when we are contributing to a fund. 43B will not apply to gratuity which we are directly paying to the employee. Here, whether you have actually paid or not, will it be relevant? Here, actual payment will be irrelevant. Actual payment will be irrelevant here. Actual payment is relevant only if you're contributing to gratuity fund. When you're directly paying gratuity to employee, it will be allowed as a deduction. It will be allowed as a deduction as soon as it becomes payable. See, when does it become payable? When the employee retires, it will become payable. So as soon as it becomes payable, you take as a deduction. Whether actually you paid, did not pay, does not matter. Got it, guys? This is about employer's contribution. Now listen to my next discussion. I'm talking to you now about employees' contribution. See, sometimes the employee becomes lazy. So what the employee does is, employee also has to contribute to RPF. Employer also has to contribute to RPF. Both have to contribute, right? So what the employee does is, he does not contribute to RPF. He gives his contribution to the employer and he tells the employer, you will anyways be sending your contribution. Along with that, you send my contribution also. Always remember, whatever employee's contribution the employer receives, it should first be taxed as income. Under 224(10), it should first be taxed as income. Then you will see how much did the employer transfer to RPF within what date? Within 139(1) date? No, within PF date. How much should the employer transfer to RPF within PF due date? That alone will be allowed as a deduction. Under which section? Under 36(1)(5)(a). These two section numbers you should remember. See, a lot of times students try to do a shortcut. They find the difference and they add the difference. No, you will first add the entire contribution. Whatever contribution employee is giving to the employer, whatever is the employee's contribution received by the employer, first tax the entire thing. Then see how much did the employer pay to the RPF within the PF due date, not 139(1) due date. Which due date? PF due date. That amount alone you subtract under 36(1)(5)(a). Let me give you one example. Let us say net profit of my assessee is 1 lakh rupees. Okay. And let us say employees' contribution to employees have directly contributed to the employer, let us say 18,000 rupees. But employer has transferred to RPF within PF due date only 7,000 rupees. Now what will you do? How will you calculate? See, how do we generally calculate PGBP? Net profit as per P&L account. How much? 1 lakh. Then what are you supposed to do with employees' contribution? You're supposed to add the entire thing. Where will you add? Where will you add, guys? You will have one heading, no, add incomes not credited but taxable. You will have one heading like this in PGBP calculation, add incomes not credited but taxable. In that heading, you will add 18,000 under which section? Under 224.10, you will add the entire amount. Then how much did you actually pay within PF due date? 7,000. So that you will allow as a deduction under 36(1)(5)(a). You will subtract 7,000, but you will subtract 7,000 where? You will have another heading, less expenses not debited but allowed. This heading you will have under that 36(1)(5)(a), you will subtract 7,000. So what will your net number be? 1 lakh plus 11,000, 1 lakh 11,000. Do not make the mistake of directly adding 11,000. You directly add 11,000, final answer will be right. But this point also step marks gone, this point also step marks gone. Following? Yes, so come on, tell me the section numbers, guys. Let's see one last time. Tell me the section numbers. Employees contribution. First, you will add under which section? You will add under section 224.10. Then you will subtract under which section? You will subtract under section 36(1)(5)(a). 36(1)(5)(a). All right, guys. Yes, so this was our discussion regarding employees contribution. Okay, so come on, one quick revision. We spoke about depreciation, then we spoke about section 35, then we learned about section 35AD, then we learned about 35D for preliminary expenses, then interest on loan we had a discussion, then we had a discussion regarding employers contribution. Employers contribution to provident fund will be allowed only if it is recognized provident fund. Then employers contribution to superannuation fund will be allowed only if it is approved superannuation fund. Employers contribution to NPS, ATCCD, NPS will be allowed only up to 10% of employee salary, and gratuity fund will be allowed only if it is approved gratuity fund. If employer is directly paying gratuity to the employee, then it will be allowed as a deduction. Paid, not paid, doesn't matter. Then we spoke about employees contribution. First, you will add the entire employees contribution for the employer under 224.10. Here also, guys, who is the assessee? Here also assessee is the employer. You will first add the entire amount under 224.10, then whatever the employer is transferring to RPF within PF due date, that alone you will subtract under 36(1)(5)(a). Okay, I'll take you to the next discussion now. Our next discussion is about bad debts. Bad debts, if you want as a deduction, you have to fulfill some conditions. Condition number 1, the bad debts should relate to what? The bad debt should relate to assessee's business or profession. Then condition number 2, this bad debts should be earlier included in the assessee's income. It should earlier be included in the assessee's income. Let me give you one example to help you understand this point properly. Listen, let us say my assessee gave a loan, or wait, let us say my assessee gave an advance to a supplier. Okay, what entry will you pass in the books of accounts? What entry will you pass? Trade advance to supplier to bank? Yes, 10,000 rupees, let us say he paid. Now later, supplier is supposed to give raw materials, right? Supplier refused to give raw materials. So assessee told, okay, fine, give the advance back. Supplier said, sorry, I am bankrupt. I don't have money. I can't give you advance back. So what will the assessee do now? Assessee will write it off. What entry assessee will pass? Bad debts account debit to trade advance to supplier, 10,000. Now tell me, this bad debts, will it be allowed as a deduction? This bad debts. This bad debts will be disallowed. This bad debts will not be allowed as a deduction. Why? Tell me, this bad debts relates to what? It relates to trade advance. Was this trade advance a part of income ever before? It was not a part of income ever before. It will be disallowed. I'll give you even better understanding. I'll give you one more example. You will understand. Let us say my assessee made a credit sale. Credit sale, simple credit sale, guys. What entry will you pass? My assessee has made a credit sale to Mr. John, let us say. What entry will he pass? He will pass the entry John account debit to sales, 10,000 rupees, let us say. Now, John refused to make the payment. So what entry will you pass now? He refused to make the payment. So bad debts account debit to John, 10,000. Now this bad debts will you allow as a deduction? Yes, this bad debts will be allowed as a deduction. Why? Because this bad debt relates to sale, and sale would have been credited to P&L account. So sales would have been a part of assessee's income. Now did you understand condition number 2? Yes, bad debts will be allowed only if the bad debts was earlier included in the assessee's income. If the bad debts was not even included in the assessee's income earlier, then it will not be allowed as a deduction. Here, this bad debts was not included in assessee's income before. This bad debts was relating to trade advance. Will trade advance ever be credited to P&L account? No, so it was not included in income earlier. But if you look at the second example, the bad debts is relating to sales. Sales would have been credited to P&L account. Sales would have been included in income. So whenever I talk about bad debts, it should earlier be included in the assessee's income. Only then I will allow it as a deduction. But the second condition is not applicable to whom? Anybody. Second condition is not applicable to whom? Anybody knows this. Very good, Sandra. It is not applicable to bank. Also, it is not applicable to money lenders. It will not be applicable to banks and money lenders. And the third condition, condition number 3, this bad debt should be written off in the books of accounts. So we have 3 conditions. All the 3 conditions should be fulfilled. Only then this bad debts will be allowed as a deduction. Whenever you have bad debts in your question paper, you will do no tax treatment at all most of the times, but you should have a working note wherein you write assuming all these 3 conditions are fulfilled. Tell me the 3 conditions, guys. Condition number 1, the bad debt should relate to the assessee's business or profession. Condition number 2, the bad debt should earlier be included in the assessee's income. Condition number 3, the bad debt should be written off in the books of accounts. In my first example, if you see, the bad debts was relating to trade advance. Does trade advance affect my P&L account? Does trade advance come into my incomes? No. So this bad debts was not included in my income earlier. Hence, this bad debts I will not allow. I will disallow. Condition 2 not fulfilled. But second example, bad debts is relating to sale. Will sale affect my P&L account? Will sale affect my incomes? Yes. So here bad debt is relating to my incomes. This is my second condition, that the bad debt should earlier be included in my assessee's income. Aditya, I hope you understood now. Okay, now listen to my next discussion under bad debts. My second discussion under bad debts, important guys. I make a provision for bad and doubtful debts. This will I get as a deduction? No, any provision you make, any reserve you make, it will always be disallowed. Whether you make a provision, whether you make a reserve, any provision, any reserve you make, it will be disallowed. Then, can the AO ask evidence that what is the proof it is bad debt? Can the AO ask for evidence that it is bad debts? No, the evidence will be the right of entry. The right of entry, this entry which you're passing in the books of accounts, this itself will be considered as evidence. Over and above this, you don't have to prove to the AO that the debt has gone bad. Is this also clear? Everybody, guys, are you all following? So condition 1, the bad debts should relate to the assessee's business or profession. Condition 2, the bad debts should earlier have been included in the assessee's income. And condition 3, it should be written off as bad in the books of accounts. Okay, then we learned whether you make any provision or reserve, any provision, any reserve will always be disallowed. Then we learned we can't give any proof and all. Now listen to the next discussion. Listen carefully. I was supposed to receive I had a receivable from Mr. John. I was supposed to receive 1 lakh rupees. I actually received, Mr. John paid me 20,000 rupees. So how much am I still supposed to receive from him? I am still supposed to receive from him 80,000. I have no hope I will receive 30,000 rupees from him. So I wrote off bad debts written off. I wrote off 30,000 rupees. I have no hope I will receive 30,000 rupees from him, which means I still have a hope that I will receive 50,000 from him. So bad debts written off 30,000. Condition 1 fulfilled relating to the assessee's business. Condition 2 also fulfilled relating to sales. Sales was earlier included in my assessee's income. Condition 3 also fulfilled, written off as bad debts in the books of accounts. So what will you do with this 30,000 rupees? Will you allow it? Allowed, right? 30,000 you will allow. Now listen, later this Mr. John went to the Himalayas, came back, changed man. He's coming back to me and he is returning 20,000 rupees to me. What will you do with this 20,000? Later, Mr. John is giving me 20,000 rupees. What will you do with this 20,000 rupees? He is saying, I'm giving you 20,000 rupees, don't expect more. So full and final settlement. Full and final settlement, he is making 20,000 rupees. Tell me, what will you do? Will this 20,000 be taxed? Will this 20,000 be bad debts recovered? Come on, answer. Wrong. Only Rahim's answer is right. Listen, this 20,000 will not be taxed. I'll tell you why. We still had a hope how much we will receive from him. We still had a hope we will receive 50,000 from him. So this 20,000 alone received. Balance 30,000 will become what? Bad debts. Understanding this 20,000, no tax treatment because we were anyway supposed to receive 50,000. 50,000 we were anyway supposed to receive from him. But out of 50,000, he has given us only 20,000. He's saying balance money and all I will not give. So in fact, the balance 30,000 will now become bad debts and it will be allowed. Is my first example clear? Everybody? Now listen to my second example. This time, John comes to me and this time he gives me 60,000 rupees. Full and final settlement. Now what to do? Now what to do? 50,000. I was anyways hoping he'll give me. How much extra he gave me? 10,000 rupees. This 10,000 rupees will become bad debts recovered. This 10,000 rupees will be taxable. Now perfect understanding. 50,000 I was anyway supposed to receive from him. I received 60,000. So how much extra I received from him? 10,000 extra I received from him. That's going to be bad debts recovered. Shall I close this story now? Bad debt story, everybody's crystal clear. Will you be able to apply all this in the examination? Don't forget all this, all right? So this was our bad debts discussion. Now let's go to the next discussion. Our next discussion is about family planning expenditure. Point number 1. Family planning expenditure will be allowed as a deduction, but only for which assessee? It will be allowed, but it will be allowed only for company assessees. This family planning expenditure may be REVEX or it may be CAPEX. REVEX, will it be allowed? Yes. CAPEX, will it be allowed? Yes. But CAPEX will be allowed across how many installments? It will be allowed across 5 installments. Now tell me, because of REVEX, can we have a loss? Because of REVEX on family planning, can we have a loss? No. If we have a loss, you will call it as unabsorbed REVEX on family planning. Because of CAPEX, can we have a loss? No. If we have a loss, we will call it unabsorbed CAPEX because of family planning. This is a simple discussion. At this stage, let me give you a flow chart. I incurred REVEX. I incurred CAPEX. I incurred REVEX and CAPEX for scientific research also, for family planning also. Tell me, because of REVEX, because of scientific research REVEX, can I have a loss? Or do you have unabsorbed concept here? I can have a loss. Because of CapEx, scientific research, can I have a loss? No. If I have a loss, I will call it unabsorbed CapEx. Because of RevX, family planning, can I have a loss? No. I will call it unabsorbed RevX. But because of CapEx, family planning, can I have a loss? No. I will call it unabsorbed CapEx. Did you understand this? Now no confusion, right? Yes. So because of revenue expenditure on scientific research, yes, I can have a loss. Here, no concept of unabsorbed. Simple. Now listen to my next discussion. My assessee is incurring advertisement expense. This advertisement expense will you allow it as a deduction? It is relating to the business or profession of the assessee, hence will you allow it? Yes. But this advertisement expense is in a souvenir, or it is in a magazine, or it is in a newspaper belonging to a political party. Now will you allow it? Now, even if it relates to business or profession, still disallowed. But you will get a deduction of this where? PGBP you will disallow, fine, but it will be allowed where? I'll give you two options, ATGGB, ATGGC, or both. Trying to confuse you, you are getting confused. ATGGB only, not allowed under ATGGC. Listen. What's the difference? ATGGB is for whom? ATGGB is only for companies. ATGGC is for whom? For all others. What does ATGGB allow? ATGGB allows any contribution I make to a political party. Even ATGGC, contribution I make to political party. ATGGB, if I make a contribution to electoral trust. Even ATGGC, if I make a contribution to electoral trust. But what is the difference? If I give any advertisement in any newspaper, in any souvenir, in any magazine belonging to political party, ATGGB deduction I get, but here I don't get a deduction. Whether ATGGB, whether ATGGC, irrespective of the amount, even if it is a small amount, how should I make the payment? Two options, specified mode, non-cash mode. Both ATGGB and ATGGC, both I will allow as a deduction only if I make the payment in non-cash mode. Non-cash mode. Okay, so ATG, now did you understand this point? I discussed this just because I wanted to make this clear. Advertisement that you give in newspaper, souvenir and all, it will be allowed only under ATGGB, only for companies. It will not be allowed under ATGGC, it will not be allowed for others. So in ATGGB you have 3 points, ATGGC you have only 2 points. Advertisement point also is clear. Okay, so this was my 10th adjustment. Now listen to my next adjustment, section 37. What does section 37 talk about? This is my general deduction section. If I incurred any expense and this expense is related to the business or profession of the assessee, this expense is not a personal expense. This expense is not a capital expense. This expense is also not any penalty for non-compliance of a law. If all these conditions are fulfilled, then you will allow this expense. Any expense which we have not learned about separately, any expense which is not covered under the sections which we've learned about until now, it's not a capital expense, it is not a personal expense, it is not relating to penalty for non-compliance of law and all. It will be allowed as a deduction. Okay, this also you've understood. Now listen to my next point, my 12th point. I have two people in my story. Number one, I have Sun Pharmaceuticals Limited, which is a pharma company. And then I have Apollo Hospitals Limited, a hospital. Sun Pharmaceutical Limited is giving samples, free samples of medicines to Apollo Hospitals Limited. For Sun Pharmaceutical Limited, it is an expenditure. Do you agree? It's an expenditure, right? They are giving free samples. They are manufacturing samples. They are manufacturing medicines. They're giving it without collecting any money in return. Expense for them. For Apollo Hospitals Limited, it is a benefit. Do you agree? They don't even have to pay for the samples. They're getting those samples for free. For Sun Pharmaceutical, it is an expense. It is a business expense. It is an expense which they are incurring to advertise their medicine. Allowed or disallowed? Even though it's a business expense, it will be disallowed. For Apollo Hospitals, it's a benefit. It is a business benefit, right? It's a benefit that they're getting relating to their business. Taxable or not taxable? Taxable. Okay, so any pharmaceutical company, what are we talking about? What is this concept about? This concept is about freebies that are given to medical practitioners. Any freebies we give to medical practitioners, for the pharmaceutical company, no doubt it is a business expense, but for the pharmaceutical company, it will be disallowed. For the doctor, no doubt it's a benefit. It's a benefit, and hence it will definitely be taxable for the doctor. Okay, this concept also, simple concept. Now listen to the next discussion. My assessee is incurring CSR expenditure. What about the CSR expenditure? Allowed or disallowed? CSR expenditure assessee is incurring under Income Tax Act. Allowed or disallowed? We will see. Is this CSR expenditure fitting under other sections? If you're able to fit it under other sections, example, if you're able to fit it under section 35, then it will be allowed. But if you're not able to fit it under other sections, then by calling it CSR, you will not get a deduction. It will be disallowed. So CSR expenditure will be disallowed. Then point number 14. My assessee is making a contribution to National Fund for Rural Development. My assessee is making a contribution to National Urban Poverty Eradication Fund. Assessee is making a contribution to National Fund for Rural Development. Assessee is making a contribution to National Urban Poverty Eradication Fund. What about this contribution? You will check. You will check, does my assessee have PGBP or does my assessee not have PGBP? If my assessee has PGBP, then under PGBP, it will be allowed. If my assessee does not have PGBP, then under ATGG, it will be allowed. Getting it? Assessee is making a contribution to National Fund for Rural Development or National Urban Poverty Eradication Fund. Listen, assessee is making a contribution to National Fund for Rural Development. Assessee is making a contribution to National Urban Poverty Eradication Fund. National Urban Poverty Eradication Fund, National Fund for Rural Development. If assessee has PGBP, under PGBP, allow it. If assessee does not have PGBP, Chapter 6A, ATGGA, you allow it. CSR expenditure, if you're able to fit CSR expenditure under other section, for example, if you're able to call it scientific research, you made a contribution to IIT. Under CSR, for CSR, you made a contribution to IIT. Contribution to IIT, you can also fit it under section 35. So you can put it under any other section and you take it as a deduction. But if you're not able to put it under any other section, just by calling it CSR, not allowed. CSR expenditure is disallowed. CSR expenditure you can indirectly allow by putting it under some other section. But CSR expenditure, by just calling it CSR, you cannot take it as a deduction. It will be disallowed. All right. Then Vinayak is asking 35 CCA. 35 CCA not a part of your syllabus anymore. Your no, 35 CCA is not a part of your syllabus. You can ignore it. All right, guys, actually speaking, this comes under 35 CCA only, but still we discussed this because ATGGA is still a part of your syllabus. So it gets covered under, so you're understanding, actually speaking, this PGBP part, this part is not a part of your syllabus, but ATGGA is a part of your syllabus. That is why indirectly it gets covered. Okay, then Monica is asking if 14th point, if PGBP is net profit is less than contribution, then you'll have a loss. That's all. Then Shruti is asking CSR won't we check company law? See Shruti, that's what. You have made a contribution under CSR. And why did you contribute under CSR? Because of Companies Act. You did not do it voluntarily and all. You did it because of the obligation put on you by CSR. Okay. So whatever CSR contribution you have made, you will see if that CSR contribution is contribution to IIT, IIM and all. Under CSR, and under Income Tax Act, you have one common point. and which is contribution to IIT, IIM and all for scientific research. So if you're for CSR, if you're contributing to IIT for scientific research, then you call it Section 35 deduction, claim under Income Tax Act Section 35. But if it is any other CSR, for example, you're constructing a school or planting trees, you're understanding, or some COVID care facility you're making a contribution to PM CARES fund and all. Those CSR expenditures, you can't put it under PGBP. It will be disallowed. Shruti and Nidin, both of you understood now? Yes, if you are incurring any expenditure under CSR, if this expenditure is in the form of contribution to IIT, IIM and all, then you can fit it under Section 35 and you can claim as deduction. But if the CSR is other CSR, for example, you're constructing a school or you're trying to develop better sanitation facilities, or let us say you are helping in the promotion of games, or let us say you are helping in by contributing to PM CARES fund. So all this under PGBP, it will be disallowed. But PM CARES fund, obviously under which section you'll get as a deduction? ATG. ATG will get as a deduction. Okay, so this is it about my 13th and 14th point. Now let me take you to the next discussion. My assessee is making a contribution under voluntary retirement scheme 35 DDA. Assessee is making a contribution under voluntary retirement scheme. Now what will you do here? Voluntary retirement scheme. You will allow it as a deduction on payment basis. Payment basis means what? Only when you actually make the payment, you will allow it as a deduction, and you will allow it as a deduction across how many installments? Across 5 installments. Now you tell me, these 5 installments, where and all have we seen in PGBP? Section 35D, then family planning, capital expenditure, then Section 35 DDA. In IFHP, we have seen this in pre-construction interest also, right? Under in PGBP, where are the places that you've seen 35D, preliminary expenses, capital expenditure relating to family planning, and 35 DDA, voluntary retirement scheme. Okay, then coming to the next adjustment, whatever discount you are paying relating to zero coupon bonds, what about this discount? This discount, my assessee here is the issuer. So for my assessee, this discount is going to be an expense, guys. Yes, this expense will be allowed as a deduction across how many years? It will be allowed as a deduction across the life of the bond. It will be allowed as a deduction across the life of the bond. Let me give you an example. For example, zero coupon bonds, let us say the issue price was 90 rupees, but the redemption price is 100 rupees. I am the issuer. I am issuing bonds to you. You're giving me 90 rupees. But when I have to redeem the bonds, I have to redeem them at 100 rupees. And let us say the life of the bonds is 10 years. So now tell me, what is a discount? Discount is 10 rupees per bond. This 10 rupees will be allowed as a deduction across how many years? This 10 rupees will be allowed as a deduction across 10 years. So each year, how much will be allowed? Each year, 1 rupee will be allowed as a deduction. Now understood? So whatever is a discount under the zero coupon bonds, that discount will be allowed across the life of the bond. It will be allowed equally across the life of the bond. Okay. Now coming to the next discussion. My next discussion is about STT and CTT, Securities Transaction Tax and Commodities Transaction Tax. In the entire Income Tax Act, STT and CTT are allowed as a deduction only in one place, and that is PGBP. Even in PGBP, when will it be allowed? It will be allowed only if the assessee's business is what? Assessee's business is buying and selling shares, or assessee's business is buying and selling commodities. So a securities transaction tax is something which you pay in the stock exchange when you buy or sell shares. Commodities transaction tax is something which you pay in the commodity exchange when you buy and sell commodities. So STT and CTT which you have paid, under capital gains, will you get a deduction? Capital gains, will you get a deduction of STT and CTT? Can you call this expenses on transfer? No, there you will not get as a deduction. In the entire Income Tax Act, STT and CTT, you will get as a deduction only and only in one place. And what is that one place? PGBP. And that too, when do you enter PGBP? You enter PGBP only if the assessee's business is buying and selling shares, only if the assessee's business is buying and selling commodities. Only then you can enter PGBP. Only in PGBP, STT and CTT, you will allow as a deduction. Alright guys, so with this, all our small adjustments are over. Now we are left with all the big adjustments, all the 40 series, 44 series, all that we are left with. Okay, we'll take a small 5 minutes pause at this stage. Okay, an exact 5 minutes pause, and then we will resume again. In these 5 minutes, get up from wherever you're sitting, go walk around a little bit, and then come back, drink some water, eat something. Exactly in 5 minutes, we are starting. Shall we resume, guys? Are you back? Yes. Are you ready? Another 1 hour of solid revision? Come on, guys. Let us put in our best. Let us go ahead. So, going to the next section now. Now we're going to be starting the section 40 series. Okay. In the section 40 series, our very first section is section 40A1. When does section 40A1 apply? My assessee has incurred an expense with another person. The assessee is making payment of this expense. Either this expense is incurred with a person who's a non-resident, or the payment is going to be made outside India. This expense can be anything like rent, royalty, interest, but it should not be salaries. The assessee should have deducted tax on this expense. But violation number 1, assessee did not deduct tax. Or violation number 2, assessee deducted tax, but assessee did not remit tax. In these two cases, there will be a disallowance under 40A1. The assessee is supposed to deduct tax when? He is supposed to deduct tax in the previous year itself. He is supposed to remit tax when? He is supposed to remit tax within section 139(1) due date. So if the assessee did not deduct tax in the previous year, then this expenditure itself will be disallowed. How much will be disallowed? Full 100% will be disallowed. If the assessee deducted the tax in the previous year, but he did not remit the tax within 139(1) due date, then also we will disallow. But how much will be disallowed? Again, 100% will be disallowed. Okay, this is 40A1. Assessee has incurred an expense. Assessee is making a payment. Either the assessee is making a payment to a non-resident, or assessee is making a payment outside India. And on this payment, tax is deductible. But violation number 1, assessee did not even deduct tax in the previous year. Or violation 2, assessee deducted tax in the previous year, but he did not remit the tax within 139(1) due date. In that case, in the current year, we will disallow. But this section is a reversible section. Reversible section means what? In the subsequent year, when this default is rectified means what? Subsequent year, when the tax is deducted and remitted, in that year it will be allowed. Let us take an example to get even better clarity. Let us say my assessee has incurred an expense during the year. On this, let us say our current previous year is 21-22. The assessee deducted the tax on, let us say, 30th. Assessee incurred the expense on, let us say, 30th April 2021. The assessee deducted the tax on 30th March 2022, but the assessee remitted the tax, let us say, on 1st of July 2022. And the assessee's 139(1) due date is, let us say, 31st July 2022. Now tell me, in which year will the expenditure be allowed? In which year will the expenditure be disallowed? Tell me, when will it be disallowed and when will it be allowed? See, check one by one. Did we deduct the tax in the previous year? When did we incur the expense? In 21-22. Did we deduct the tax in 21-22 itself? Yes, we deducted on 30th March 2022, which is within the previous year. We deducted the tax in the previous year. Did we remit the tax within 139(1) due date? Did we remit the tax within this date? Yes, we remitted within 139(1) due date. So will we have any disallowance? No. Will it be allowed? Yes. When will it be allowed? In this previous year 21-22, it will be allowed. Simple, guys. This was my first example. Now listen to my second example. In my second example, again, I'm talking about previous year 21-22. The expenditure was incurred on 30th April 2021. The tax was deducted on 30th April 2022 and it was remitted on 1st July 2022. 139(1) due date is 31st July 2022. Now tell me quickly, when will this be allowed and when will this be disallowed? Did we deduct the tax in the previous year? Did we deduct the tax in 21-22? No. We deducted on 30th April 2022, which means we deducted only in 22-23. We did not deduct in the previous year. We did not deduct. Therefore, in 21-22, it will be disallowed, guys. How much will be disallowed? Full 100% will be disallowed, right? But when did we deduct and remit? When did we rectify the default? When did we rectify the default? When did we remit? We remitted in which previous year? Previous year 22-23. So in 22-23, it will be allowed. In 22-23, full 100% will be allowed. Are we clear with this example? Yes, one last example, guys. One last example. Example number 3. Previous year 21-22 only. The expense was incurred on 30th April 2021. The expenditure was that the tax was deducted on 30th April 2022, but the tax was remitted on 1st of May 2024. Now tell me, when will it be allowed and when will it be disallowed? First of all, in 21-22, did we deduct the tax in the previous year? In the previous year, no, we did not deduct the tax. So first of all, in 21-22, it will be disallowed. Then when did we remit? When did we rectify? When are we remitting? Which year is this? This is previous year 24-25. In 24-25, it will be allowed. So if you did not deduct the tax in the previous year, or you deducted the tax, but you did not remit within 139 due date, then current year it will be disallowed. Later, whenever you remit the tax, in that year it will be allowed. Okay, so this was section 40A1. Please notice 40A1 does not apply to salaries. Okay, now listen to my next adjustment, my 19th adjustment. I simply copied paste 40A1 itself to show you where exactly the differences are. I am discussing with you another section 40A1A. 40A1A covers salary also. Here I am making a payment to resident. I am making a payment to resident and I am making the payment in India. 40A1 said I am making the payment to a non-resident or I am making the payment outside India. In 40A1A, I am making a payment to a resident and I am making the payment in India. And on this payment, I'm supposed to deduct tax. But I did not deduct tax in the previous year, or I deducted in the previous year, but I did not remit within 139 due date. It will be disallowed. But under 40A1A, tell me how much will we disallow? Will we disallow full 100%? No, here we will disallow only 30%. And even this is reversible, which means subsequent year, whenever I make the remittance, in that year it will be allowed. This is 40A1A. Okay, now coming to another similar section, the 20th concept. Here I am discussing with you about section 40A3. 40A3 because 40A1 did not cover salaries. Right? 40A1, remember, it did not cover salaries. Why it did not cover salaries? Because for salaries, we have another section, section 40A3. What does 40A3 say? 40A3 is not covering other expenses. 40A3 is covering only and only salary expense. Okay, I'm making the payment of salary to a non-resident or I'm making the payment of salary outside India. I did not deduct tax at all. It will be disallowed 100%. Here we have only one violation. Here we do not have the second violation. This is 40A3. Perfect understanding, guys? 40A3, only one violation. What is that one violation? I did not deduct tax. I deducted tax, but I did not remit in the previous year. No disallowance. Disallowance will be attracted only when I did not even deduct the tax. Only then disallowance will be attracted. All right, guys. Now listen, in section 40A1 and in section 40A1A, in both the sections, we have a common point. The common point is the assessee committed the first violation. What is the first violation? The first violation is that the assessee did not deduct. When is my assessee supposed to deduct? He's supposed to deduct in the previous year. My assessee did not deduct in the previous year. Okay. But then the recipient of the income, he has properly filed income tax return. In that income tax return, that assessee has considered, that recipient has considered the income. See, for my assessee, this is an expense, but for this person, it will be an income, right? So this person I'm talking about, this person, Mr. Blue, he has properly filed income tax return. He has properly considered this income in his income tax return. He has properly paid tax also on this return. And we also have a chartered accountant certificate saying all these conditions are fulfilled. In this case, even though this assessee did not deduct tax in the previous year, still for this assessee, there will be no disallowance. Did you understand this point? This is a very tiny point. I'm guessing some of you might have even forgotten about this. But now, are you able to recall? Do you remember learning something like this? Yes, guys. So even though my assessee, and one more thing, did you notice? I'm talking only about the first violation. I'm giving an exemption to the assessee. The assessee has committed a violation, only the first violation. What is the first violation? Did not deduct tax in the previous year. So assessee did not deduct tax in the previous year, but the recipient, that other person, the person who's receiving the income, he has filed his income tax return properly on time. In this income tax return, he has considered that income also. On that income, he has paid tax also, and we also have a CA certificate for this. If all these conditions are fulfilled, even though my assessee has committed a violation, even though my assessee has not deducted tax, still there will be no disallowance. Okay, so this is it with 40A1, 40A1A and 40A3. So we discussed 20 concepts. Now listen to the next discussion, the 21st concept. My assessee is paying some tax. See, let me restart. My assessee is the employer. Okay, this assessee is giving some non-monetary perquisites to the employee. What are non-monetary perquisites? Can you give me some examples of non-monetary perquisites? Anybody? For example, assessee is giving RFA, or assessee is giving a motor car, or assessee is giving a laptop. Some non-monetary perquisite assessee is giving to the employee. Now for this employee, this is going to be income, guys. For the employee, on this income, he has to pay tax, guys. Unnecessary burden on this employee. So what the employer tells the employee is, tax on these non-monetary perquisites, employee will bear. So the employer is telling the employee, my assessee is telling the employee, see, I'm going to give you non-monetary perquisites. Tax on these non-monetary perquisites, I itself will bear. You don't worry. Guys, on this, regarding this point, there is a very good question in your November 2022 RTP. Okay, make sure you watch the video regarding this point. There's a very good point. There's a very good question relating to this concept under November 2022 RTP. Okay, make sure you see it in the MCQ questions, it is there. Okay, so assessee is giving non-monetary perquisites to the employee, and the assessee is telling the employee that on these non-monetary perquisites, whatever is your tax burden, I will bear. Now, for this assessee, don't you think it is an expense? And that too a business expense? Yes, and for this employee, don't you think it is a benefit? Because employee's obligation, employer is bearing. Yes, for the employer, for the assessee, it's a business expense, but still it will be disallowed. For the employee, it's a benefit, but still it will be exempt. Okay, so here we're talking about tax on non-monetary perquisites. Employer is giving non-monetary perquisites to the employee. On these non-monetary perquisites, tax also employer is saying he itself will bear. This tax which the employer is bearing is definitely a business expense for the employer and a benefit for the employee. But this business expense will be disallowed for the employer. This business in this income, this benefit will be exempt for the employee. Understood, guys? This was a 21st discussion. Now listen to my next discussion, my 22nd concept. We're going to be discussing everything about partners here. Listen carefully. Two things. Thing number one, my partner is getting interest from the partnership firm. For this partnership firm, it is an expense. Do you agree? For this partnership firm, this expense will be allowed as a deduction, but maximum how much will be allowed? Maximum only 12% per annum will be allowed, and it will be allowed only if it is specified where? Only if it is specified in the partnership agreement. Whatever is allowed for the partnership firm, that only will be taxed for the partner. Whatever is allowed for the partnership firm, that only will be taxed for the partner. Okay. By the way, there is a question in the chat box. Vishwajit is asking us, should the employee pay tax on the perquisite? No, right? Because employer itself is bearing the burden of this tax. Vishwajit, I think you should definitely look at that MCQ discussion of the RTP. Your question will get clarified. You need that clarity because your question shows that the clarity is not there. You haven't seen the MCQs of the November 2022 RTP, I'm very sure. Correct? So I think you should see it because you will get an idea there. Employee is not going to be paying the tax. Employee is not going to be paying the tax on these perquisites. Employer is going to bear the burden of this tax. So again, employee doesn't have to pay the tax, okay, because employer is taking care of it. Coming to my 22nd discussion about partners, whatever interest my partnership firm gives to the partner, this interest will be allowed for the firm if it is up to 12% per annum. Whatever is allowed for the firm, that only will be taxed for the partner. For example, let us say the partnership firm gives interest to the partner rupees 1,20,000 rupees, and this 1,20,000, or let us say 1,50,000 rupees, this is at the rate of 15%. So you tell me, for the partnership firm, how much will be allowed? For the partnership firm, how much will be allowed? For the partnership firm, only 1,20,000, 12% will be allowed. For the partner, how much will be taxed? Copy paste. Whatever is allowed for the firm, what is allowed for the firm? 1,20,000, same number, copy paste for the partner. Whatever is allowed for the firm will be allowed for the, whatever is allowed for the firm will be taxed for the partner. Similarly, number 2, the partner is getting salary from the partnership firm. Now this salary for the partnership firm, the salary is going to be an expense, guys. This expense will be allowed to the partnership firm. Number 1, it should be specified where? It should be specified in the partnership deed. Number 2, what kind of a partner? Only to active partners we can pay salary. And number 3, there is a limit. Now, what is a limit? The limit depends upon what? The limit depends upon the book profit of the firm. Now, what is book profit? Book profit is nothing but normal, usual PGBP without considering salary. Consider all other adjustments. Just without considering salary alone, find the book profit. That's going to be the, without considering the salary alone, find the PGBP. That's going to be the book profit. Okay, you see what is a book profit. 3 things are possible. Either this might be a profit number or this might be a loss number. If it is a profit, then tell me the slab. Up to how much? Anybody, do you remember the slab? Up to 3 lakh. On the first 3 lakh of the book profit, what do you do? How do you calculate? Tell me, what percentage? 90% of book profit, or what number? Or 1,50,000, whichever is higher will be allowed. On the balance book profit, on whatever balance book profit you have, how do you calculate? Balance book profit, you will straight away calculate 60% of book profit. This will be the numbers. What if it's a loss? What if this book profit is a loss? In that case, what will be the maximum limit? Maximum limit will straight away be 1,50,000. Okay, so whatever salary, my first discussion was about interest. My second discussion was about salary. Whatever is allowed for the partnership firm, that whatever is allowed for the partnership firm, that same number will be taxed for the partner. Okay, whatever, same thing about interest, same thing even under salary, whatever is allowed for the firm, that same number will be taxed for the partner. Okay, remember, salary will be allowed only if it's an active partner also called as active partner, also called as actual partner, also called as ostensible partner. Okay, and what is the limit, guys? The limit depends upon the book profit of the firm. If the book profit is if it's a negative number, if it's a loss, then maximum 1,50,000. If it's a profit, then the maximum number would be up to 3 lakh, 90% of book profit, or 1,50,000, whichever is higher. On the balance book profit, 60% of the book profit number. All right, so this was about our salary discussion, section 40B. Now coming to the next discussion, concept number 23, section 40A, subsection 2. Section 40A, subsection 2, listen carefully. Here what happens is my assessee is incurring an expense. My assessee is incurring an expense, and assessee is incurring an expense with whom? For this expense, assessee is making a payment to whom? To related parties, to relatives, specified persons, related parties. Now, who are these related parties? There's a huge definition given in the Income Tax Act, but 40A2 is a section which is majorly tested in depth only in CA final. At your CA intermediate level, what do you need to know? Who are these related parties? If my assessee is an individual, if I am the assessee, then my spouse, my brother, my sister, my lineal ascendant, and my lineal descendant. Who is lineal ascendant? All my parents, grandparents, great-grandparents, and so on. Then all my children, grandchildren, great-grandchildren, and so on. So if my assessee is an individual, then spouse, brother, sister, lineal ascendant, lineal descendant. In fact, if my assessee is a company, then who are the relatives? In that case, the directors will be considered as relatives. Even relatives of directors also will be considered as relatives. Okay, so if my assessee is an individual, then spouse, brothers, sisters, lineal ascendants, and lineal descendants. My assessee is making an expenditure. My assessee is incurring an expenditure. He has to make a payment to a related party, and this expenditure is excess or unreasonable. Tell me, what will you disallow? Will you disallow the entire expenditure, or will you disallow only the excess? You will disallow only the excess portion. You will disallow only the unreasonable portion. Okay, if assessee is making a payment to a relative, and if this expense is excess or unreasonable, then to the extent to which it is excess or unreasonable, to that extent it will be disallowed. Section number 48(2). Okay, now coming to the next discussion, section 40A(3). Section 40A(3) talks about what kind of expenses. 40A(3) talks about those expenses for which you're making the payment more than 10,000 rupees. If you're making the payment, listen, here my assessee has incurred an expenditure. My assessee has incurred an expenditure, and for this expenditure, my assessee is making a payment. This payment is more than 10,000 rupees. This payment my assessee is making in a single day. Assessee is making this payment to a single person. This expenditure assessee is making the payment against a single invoice. What will you suggest to the assessee? How should this payment be made? This payment should be made in specified mode. What are specified modes? You know very well: account paycheck, account pay bank draft, ECS, and other electronic systems. Please remember, whatever you're learning under 40A(3) is not only applicable in PGBP, the same thing copy paste is also applicable in IFOS. Any expenditure you have, whether under PGBP, whether under IFOS, if you're making a payment, and if the payment is more than 10,000, you should be making the payment only in specified mode. The limit is generally 10,000, but this limit becomes 35,000 when? This limit becomes 35,000 if you're making a payment for plying, hiring, leasing, goods, carriages. See, a lot of times students have a misconception that the limit is 35,000 for truck operators. See, have the clarity. If truck operator is making the payment, for him limit is 10,000 only. Then is the limit 35,000. If assessee is making a payment to truck operator, you're understanding? If assessee is making a payment to truck operator for plying, hiring, or leasing goods, carriages, then for this payment the limit will be 35,000. Did you understand this discussion? Yes, I'll repeat once again. The limit is generally 10,000, guys. When does the limit become 35,000? If assessee is making a payment to a truck operator. If assessee is making a payment for plying, hiring, leasing goods, carriages, there the limit will become 35,000 instead of 10,000. This is my first point. Now listen to my second point. When will 40A(3) not apply? Section 40A(3) will not apply in rule dash cases. What rule comes to your mind? Rule 6BD cases. What are the points? And over here you have a list of points. Number 1, if assessee is making a payment to the LIC, if assessee is making a payment to the RBI, if assessee is making a payment to government, how much ever you're paying, pay however you want, it doesn't matter. Also banks. Assessee is making a payment to LIC, RBI, government, or banks, pay however you want. Then assessee is making the payment by credit card. Assessee is making the payment by debit card. Even all this will be included. Assessee is making the payment by book adjustment. What is book adjustment? I have to pay you money, you have to pay me money. We are setting it off. That is book adjustment. So I am supposed to pay you money, you are supposed to pay me money. I am not actually paying you money. I am setting it off. In the books itself, one entry I am passing, I am setting off my receivable against my payable. Even that is allowed. Then, if you are going to make a payment to the cultivator, if you are going to make a payment to the farmer, because you're going to purchase agricultural products from him, or you're going to make a payment to a person from whom you're buying dairy products, poultry products, fishing products and all, you can make the payment however you want, doesn't matter. Then number 5, you're making a payment to a person for in relation to cottage industry, and that too without power. Even here, make the payment however you want. Condition in the 6th situation, you're making payment to a person who lives in a village, and in that village there is no banking channel available. Make the payment however you want. Then you have to make urgent payment on a day on which the bank is closed. On a day on which the bank is closed, you can make the payment however you want. And lastly, if you're making a payment to an authorized money changer, you're taking INR, you're taking cash and going to a money changer and you're asking him, here, take this money, give me dollars in return. You're making any payment to an authorized money changer, even this will be allowed as a deduction. How much ever you pay doesn't matter. 48.3 will not apply. So 48.3 says if you're making the payment of any expense more than 10,000 rupees, please make the payment only in specified mode. This 10,000 rupees becomes 35,000 rupees if assessee is making a payment for plying, hiring, leasing goods carriages. Rule 6TD cases, I'm sure you would be aware of very well. In these cases, however you want, you can make the payment. Even though more than 10,000, pay however you want in any mode you want. It doesn't make a difference. You will not have a disallowance. Are you aware of this section 48.3a? What is 48.3a? 48.3a. Come on, guys, important point. See, listen very carefully. My assessee has incurred an expenditure in the current year. I'll give you an example. AMC is authorized money changer. Listen, my assessee has incurred an expenditure in the current year. Let us say my assessee has incurred rent. The due entry assessee has passed on 31st March 2022. The due entry is rent account debit to landlord account. Assessee did not make the payment. Amount is 30,000. Tell me, current year, will you disallow? Will you disallow under 48.3? No, right? Under section 48.3, there will be no disallowance because payment was not made in non-specified mode. Forget about non-specified mode. Payment is not even made. So no disallowance. Then on 1st April 2022, assessee makes the payment. Assessee passes the entry landlord account debit to cash. Assessee pays by cash 30,000 rupees. Now will you disallow? See, this 31st March 2022 is which previous year? Previous year 21-22. 1st April is previous year 22-23. So what is my assessee doing? In the subsequent year, assessee is making payment of the expense in non-specified mode. In cash, he has paid. Now, will you disallow under 48.3? Yes or no? Even now, you cannot disallow under 48.3. Why can't you disallow under 48.3? Because you can disallow only if it's an expense, first of all. You tell me, in 22-23, is rent even an expense? Come on, guys, answer. In 22-23, is rent even an expense? No. Rent is an expense of which year? Rent is an expense of 21-22. In 21-22, I cannot disallow. Why? Because in 21-22, I did not even make the payment. In 22-23 also, you cannot disallow because 22-23, it's not even an expense. Only if it's an expense can we talk about disallowing it. So this is how assessees were escaping tax. That is why the Income Tax Department introduced section 48.3a. 48.3a says if you incurred an expenditure in an earlier year. So when did you incur the expenditure? In an earlier year, and you're making the payment when? You're making the payment in the current previous year, and this payment you are making in non-specified mode. What are the conditions, guys? Condition number 1, you incurred the expense in an earlier year. I incurred the expense in 21-22, but you're making the payment in the current previous year. Current previous year 22-23, I'm making the payment, and you're making the payment in non-specified mode. If all these conditions are fulfilled, then see, we cannot touch 48.3 because 48.3 talks about disallowance. It's not an expenditure of the current previous year. I can't disallow. But 48.3a will start applying, and under 48.3a, I will assume it to be your income. It will be deemed income. So for my assessee in previous year 22-23, 30,000 rupees will be deemed income. It will be deemed to be income under section 48.3a. Understood, guys? Yes, this is 48.3a. 48.3a says my assessee has incurred an expenditure in an earlier year, and relating to that expenditure of the earlier year, current year assessee is making a payment, that too in non-specified mode. So now I can't disallow under 48.3, but whatever was whatever was the expenditure which you're making the payment now, I will assume it to be your income. I will deem it to be your income. Even your same 10,000 limit applicable. You're making the payment more than 10,000, you're making the payment in non-specified mode. Now, you might wonder, why is she unnecessarily complicating? You might wonder, same thing I can talk about even in 48.3. No, guys, there will be a small difference. See, it's going to be deemed to be income, which means in PGBP calculation, you're going to add it back. Do you agree? Do you agree? In PGBP of 22-23, you're going to add it back. But under adding, you have two headings. What are your two headings under PGBP to add back? Your first heading is add expenses which are debited but not allowed. And what is second heading? You add incomes which are not credited but taxable, right? So under which heading will you add? You have to add, no doubt, because you've done a violation. But you will add it under which heading? First heading or second heading? You will add it under second heading, because we will assume it to be income. It will be deemed income. If I don't teach you 48.3a, then you will disallow it under 48.3. 48.3 you will disallow under expense debited but not allowed. But is this an expense debited in the current year? No. So you can't disallow under 48.3. So that is why you will assume it to be income, deemed income. So under income not credited but taxable, this is where you will add it back. Now understood? Now 360 degrees, full 100% you've understood 48.3. So under 48.3 we learned, if my assessee is making a payment of an expenditure, and if the payment is more than 10,000, assessee please make the payment in specified mode. Instead of 10,000, the limit will become 35,000 if assessee is making a payment to a transport operator for plying, hiring, leasing goods carriages. By the way, then when the assessee is paying gratuity, retrenchment compensation and all, there the limit will become what? Any idea? Anybody? Generally, the limit is 10,000. When we're making the payment for plying, hiring, leasing goods carriages, 35,000. When I make a payment towards gratuity, retrenchment, compensation, terminal benefits and all to the employee, there the limit will become 50,000. Perfect answer. Vishwajit, Abbas, Aditya. Perfect answers, guys. There the limits will become 50,000 and not 10,000. Okay, then we learned about Rule 6DD cases, and then we learned about 48.3a. Under 48.3a, we learned about 3 conditions. Condition number 1, I incurred an expense in the earlier year. Current previous year, I am paying more than 10,000 in non-specified mode. Then whatever I am paying in non-specified mode, that amount will be deemed to be my income. It will be deemed to be my income under 48.3a. But tell me, how much should be deemed to be income? Only excess over and above 10,000, right? Or the entire amount? The entire amount, not just the excess number, the entire amount. Okay, so this is concept number 24. All right, this was 48.3. Now listen to our next discussion, 43b next. 43b. What does section 43b talk about? Listen, 43b talks about some 6 to 7 payments. These payments, if you want a deduction, you have to make the payment within 139 ringgit. So what are the payments? Number 1, any tax, any duty, any cess, any fees. When I talk about tax, duty, cess or fee, I'm talking only about those tax, duty, cess or fee which I have to pay to whom? Which I have to pay to the government. Shakir, no, capital gains tomorrow, today only PGBP. Okay, any tax, duty, cess or fee which I have to pay to the government. Then number 2, employer's contribution. Employer's contribution to what? Employer's contribution to RPF. Employer's contribution to approved superannuation fund. Then employer's contribution to approved gratuity fund or any other fund for welfare of employees. See, the law does not say recognized, approved, approved. Then why am I using these words? Because if it is unrecognized, it will anyways be disallowed. If it is unapproved superannuation fund, it will anyways be disallowed. Do you remember we had learned that? I'll show you where. Here. If it is provident fund, it has to be recognized. If it is unrecognized, it will anyways be disallowed, guys. If it is superannuation fund, it has to be approved. If it is unapproved, anyways it will be disallowed. So that is why I'm talking about recognized, approved and approved here. So it has to be approved funds or recognized funds. Then number 3, the point which students forget most of the times, bonus to employees and commission to employees. This commission may be turnover based commission, may be fixed commission, maybe any commission. Any bonus or commission you pay to employees, even on that 43B will apply. Then number 4, if assessee has to make payment of any interest, to whom many people are covered here, interest to public financial institution, then interest to state finance corporation, then interest to state industrial investment corporation, then any interest which you have to pay to scheduled bank, then any interest which you have to pay to NBFC. So many people are covered. See, relatives and all not covered. You have to pay interest to relatives. Will 43B apply? No. Company has to pay interest to directors. Will 43B apply? No. Partnership firm has to pay interest to partners. Will 43B apply? No. 43B will apply only when I have to make payment of interest to public financial institution, state finance corporation, state industrial investment corporation, scheduled bank or NBFC. Then number 5, when we have to pay leave salary to employees, even here 43B will apply. And number 6, if my assessee has to make payment, any payment to railway, assessee used railway assets, assessee has to make payment to railways, in these 6 payments alone 43B will apply. These 6 expenses, if my assessee wants these expenses to be allowed, then what should the assessee do? The assessee must actually make the payment of these expenses when within section 139(1) due date. If the assessee does not make the payment within 139(1) due date, what will you do? You will disallow. But if you disallow, is it a reversible section? Yes. Later, whenever you make the payment, in that year it will be allowed again. Okay. So 43B, these 6 expenses we're talking about, these 6 expenses, if you want to make, if you want a deduction, you must actually make the payment within 139(1) due date. Only if you make the payment within 139(1) due date, only then it will be allowed for you. If you make the payment after 139(1) due date, it will be disallowed for you. But if it is disallowed, don't worry, it will be reversible. Later, whenever you make the payment, in that year we will allow it for you. All right. Now listen, but 43B is not over. We still have some more points to learn under 43B. My assessee had to pay interest on loan. My assessee was not able to pay this interest on loan. So this interest on loan was converted into loan. Will this itself amount to payment? Will conversion of interest on loan to loan, will this itself amount to payment? Yes or no? No. Conversion of unpaid interest into loan will not amount to payment. It will not be allowed. See, when will it be allowed? As and when you keep repaying this loan, only then it will be allowed. Okay, then the next point. We had unpaid GST. We were not able to pay GST to the government. This unpaid GST was converted into loan. Will this be considered as payment? Yes, this will be considered as payment. So conversion of unpaid interest into loan will not be considered as payment, but conversion of unpaid GST into loan, this will be considered as payment. Got it, guys? Yes, understood this point. So we're learning about 43B. 43B, totally 6 expenses we have learned. What are the 6 expenses? Come on, guys, we're almost towards the end. We're almost towards the end. Pay attention. We have 6, we're talking about 6 expenses here. Number 1, any tax, duty, cess or fee which we have to pay to the government. Number 2, we're talking about employers' contribution to RPF, superannuation fund, gratuity fund, any other fund for the welfare of employees. Number 3, bonus and commission which we have to pay to the employee. Number 4, interest, but not all interest, only interest which we have to pay to these 5 people: public financial institution, state finance corporation, state industrial investment corporation, scheduled bank, and NBFC. Then we learned any leave salary which we have to pay to the employee, even this will be covered under 43B. And lastly, any assessee, any amount which my assessee has to pay to the railways for use of rail assets, even this will come under 43B. All these payments which my assessee is making, assessee will get a deduction only if the assessee actually makes the payment within 139(1) due date. Only then assessee will be allowed as a deduction. Only then this expenditure will be allowed as a deduction. If the assessee does not make the payment within 139 due date, then it will be disallowed. But don't worry, later whenever you make the payment in that year, I will allow it again. Then we learned two special points. We have two case laws as well as circulars of the income tax department regarding this. If we have unpaid interest on loan, if you are going to convert unpaid interest on loan into loan, it will not amount to payment. It will not be treated as if it is actually paid, and hence it will not be allowed as a deduction. But in case we have unpaid GST, we are not able to pay GST to the state government, and that is why the state government is treating it as loan. They have converted the unpaid sales tax into loan. It's as if the government has given us a loan and we have to repay the loan. This will be considered as payment. We have circulars as well as rules regarding this point. All right. Now, Seturaman is asking us a very good question. 30% or 100%, how much will be disallowed? Entire 100% will be disallowed. 30% disallowance you have only in one place. And what is that one place? 40A1A. That is the 40A1A, remember? I have to make a payment to a resident and in India, and I have to make, and I did not deduct tax, or I deducted tax, but I did not remit it within 139(1) due date. There alone, 30% you disallow. All the other places we disallow the entire 100%, even your entire 100% will be disallowed. All right. So these are two special points, guys. Interest on loan, we are converting into loan, not considered as payment. But unpaid GST converted into loan will be considered as payment. This is 43B. Now coming to my next section, section 43CA. Guys, listen, please listen to 43CA very, very carefully, because according to me, whatever estimate I am able to make, 43CA for sure you will find in your November 2022 question paper, either as an MCQ or as a descriptive paper or as a descriptive part. But 43CA should most probably it should be there in your question paper. Listen carefully. In 43CA, we have some conditions. When does 43CA applies? 43CA applies only if condition number 1, my assessee should be a real estate dealer. Real estate dealer means what? His business should be buying and selling properties. That is, stock in trade should be nothing but property. Okay. Condition number 2, he's selling properties. So what is he selling? He's selling properties, land, building, or both. He is selling. He's a real estate dealer. This land, building, both. This is going to be his stock in trade. Okay. Condition number 3, he is selling in such a way that the SDV of the property is more than 110% of the selling price. He is selling it in such a way that SDV is more than 110% of selling price. If all these conditions are fulfilled, then the actual selling price I will ignore. And instead of actual selling price, which number will I take? I will take the SDV. This SDV number will be deemed to be the selling price number. Till here, did we understand, guys? Come on, quick, tell me. 43CA, who is my assessee? My assessee is a real estate dealer. What is my assessee selling? My assessee is selling land, building, or both, which is a stock in trade. Condition number 3, he's selling in such a way that SDV is more than 110% of selling price. If all these conditions are fulfilled, then I will ignore the selling price number. I will ignore the selling price number, and instead, which number will I take? I will take the SDV number. This SDV number will be deemed to be the selling price number. Okay, now listen. This 110%. Instead of 110%, you will take which number? We have the new provision. Instead of 110%, you will take 120%. I'm telling you, right, that most probably you will be getting 43CA in your examination. That will be relating to this 120% number. Instead of 110%, you will take 120% if some conditions are fulfilled. Condition number 1, the property should be a residential property. The property should be a residential unit. Condition number 2, when did you sell away the property? You should have sold away the property within a certain period. The period is 12th November 2020 to 30th June 2021. In this period, we should have sold away the property. Condition number 3, this should be sold by way of first time allotment. First time allotment means what? New property, first time the seller is selling. And condition number 4, the consideration should be up to how much? Anybody? Consideration should be up to 2 crores. If all these conditions are fulfilled, then instead of 110%, we will take 120%. Even relating to this, there's a very good question in your November 2022 RTP, which you should definitely see in the descriptive part, not in the MCQs part, in the descriptive part. Okay, so 43 CA, here we have 4 conditions. If all the 4 conditions are fulfilled, then you will not consider 110%, instead you will consider 120%. Now listen, same provision is also there in 56.210. What is 56.210? IFOS, gift. All right, when I talk about gift, I'm talking about immovable property which we have received for inadequate consideration. Okay, so even over there we compare with 10% of consideration. Instead of 10%, we will compare with 20% of consideration. So same provision is there even in IFOS, but similar provision is not there in 50C. What is 50C? Same thing. If it is capital asset, if it is not stock in trade, if it is capital asset, then 50C will apply, right? In 50C, you don't have this provision of 120%. In 50C, we still apply only 110%. Only in gift and in 43 CA, only in these 2 places, instead of 110%, you will apply 120% if these conditions are fulfilled. Okay, this was 43 CA. But listen, guys, listen. We're talking about SDV number. But if the assessee starts comparing SDV with FMV, if assessee starts comparing SDV with FMV, then what will the AO do? AO will go to whom? AO will go to a valuation officer. And what will this valuation officer do? This valuation officer will find the FMV. This FMV, 2 things are possible. Either this FMV may be below SDV, or this FMV may be more than SDV. If this FMV is less than SDV, what will you do? In that case, you will take the FMV number or the selling price number, whichever is higher. If FMV is more than SDV, then what will you do? You will stick to SDV. Same thing you have in 50C also. Same thing you have in 56.210 IFOS gift also. Okay, so come on guys, 43 CA, what are my conditions? Condition means conditions. Condition number 1, assessee should be into real estate business. Condition number 2, assessee must be selling land, building or both. That is, land, building, both should be his stock in trade. Condition number 3, his stamp duty value should be more than 110% of selling price. If all these 3 conditions are fulfilled, I will ignore the actual selling price and I will take the SDV number. The SDV number will be deemed to be the selling price number. But sometimes, even though the law talks about stamp duty value, the assessee may start comparing SDV with FMV, in which case assessing officer will go to a valuation officer and will ask him to find the FMV number. This FMV may be below SDV, this FMV may be more than SDV. If it is below SDV, then FMV or the selling price number, whichever is higher, I will take. If this FMV is more than SDV, then I will stick to the SDV number itself. This was our discussion regarding 43 CA. Same point you have even in 50C and in 56.210. Then we learned in 43 CA and in 56.210, instead of 110%, we will take 120% if these conditions are fulfilled. Condition number 1, it should be a residential unit. Condition number 2, when are we selling this unit? In this period. Condition number 3, it should be a first time allotment. First time allotment means it's a new property. Just now we constructed it and first time that property is being sold. Seller sold it to me, I am reselling. It shouldn't be like that. It should be first time allotment, which means new property. For the first time, the seller is allotting the property to me. Okay, then comes the third condition, the first time allotment, nothing but new property basically. Condition number 4, the consideration should not be more than 2 crores. So all these conditions have to be fulfilled. Then instead of 110%, you will take 120%. Okay, so this was 43 CA, my concept number 26. Now going ahead, my concept number 27. After this, we will start off the section 44 series. Okay, under 44 series, and by the way, guys, before I forget, thank you for reminding me, Basit. We will take SDV on which date? We will prefer to take SDV on the date of agreement, but we can take SDV on date of agreement only if some conditions are fulfilled. What are the conditions? Condition number 1, at least some consideration, at least some advance. Condition number 2, the buyer should have paid to the seller. When? Buyer should have paid to the seller on or before the date of agreement. In what mode? In specified mode. Okay, so in SDV, we will prefer to take on date of agreement if these conditions are fulfilled. What are the conditions? At least some consideration buyer should have paid to the seller on or before the date of agreement in specified mode. If all these conditions are fulfilled, then we will take SDV on date of agreement. Even if one condition not fulfilled, then we will take SDV on which date? On date of registration. Okay, then coming to the section 44 series. Under section 44 series, we have to learn about 44AA, we have to learn about 44AB, and then we have to learn about the three presumptive sections, 44AD, ADA, and 44AE. This is the last part of our PGBP chapter. Okay, so listen carefully, guys. Last 15 minutes. At this point, do not compromise. Okay, section 44AA. Section 44AA talks about compulsory maintenance of books of accounts. Compulsory maintenance of books of accounts. When does the assessee have to maintain the books of accounts? What books of accounts, and what kind of books of accounts? Listen, we will learn this in some parts. In the first part, I'm talking only about specified professionals. Who are these specified professionals? You know very well. Doctors, lawyers, engineers, architects, chartered accountants, interior decorators, company secretaries, film artists, authorized representatives, IT professionals. They all come under specified professionals. Specified professionals will have to maintain, they have to compulsorily maintain those books of accounts which will help the AO compute their total income. So specified professionals, part 1, specified professionals have to maintain at least those books of accounts which will help the AO compute the total income. Then coming to part 2. In part 2, again, I am talking about same specified professionals, but I am adding an extra condition. If my assessee happens to be a specified professional and gross receipt, if you see in preceding previous year 1, preceding previous year 2, preceding previous year 3, all the 3 years gross receipt, if you see, it is more than 1,50,000, more than 1,50,000, more than 1,50,000 in all the 3 preceding previous years, then these specified professionals have to maintain specific books. Specific books, they have to mandatorily maintain some specific books. What are those specific books? Number 1, they have to maintain cash book. Number 2, they have to maintain journal, but journal only if they are following what basis of accounting? Journal only if they are following mercantile basis of accounting, otherwise not required. Then they have to maintain ledger. Then they have to maintain carbon copies of bills which are exceeding 25 rupees. Then they also have to maintain original copies of bills. They also have to maintain a daily case register. They also have to maintain their inventory register. So specified professional, 3 preceding previous years, all the 3 preceding previous years, more than 1,50,000 gross receipts, then they have to maintain these specified books. So both my part 1 and part 2 was about whom? My part 1 and part 2 was both about specified professionals. Now coming to part 3 will apply to all others. All others would mean what? All others would be number 1, non-specified professionals, and all others will also include my business assessees, guys. Yes, so in case my assessee is a non-specified professional, or in case he is a business assessee, then what to do? In that case, we will see, is this assessee an individual or HUF, or is this assessee any other person? If it is individual or HUF and this assessee's income is more than 2,50,000, or this assessee is an individual or HUF and turnover or gross receipt, as the case may be, is more than 25 lakhs in any 1 out of 3 preceding previous years, then you have to maintain such books of accounts which will help the AO compute your total income. Okay, if assessee is any other assessee, then the numbers will change. Income is more than 1,20,000, or the turnover or gross receipts are more than how much? Instead of 25 lakhs here, 10 lakhs in any 1 out of 3 preceding previous years. Then maintain such books of accounts which will help the AO compute your total income. Then coming to one last part, part 4, tell me, for how long are you supposed to maintain the books of accounts? For how many years are you supposed to maintain the books of accounts? You're supposed to maintain the books of accounts for 6 years from the end of the relevant assessment year. You're supposed to maintain, you'll have to see what is the end of the relevant assessment year. From the end of the relevant assessment year, for 6 years, you have to maintain. End of the assessment year, 6 years. Don't you think this is nothing but 7 years from the end of the previous year? Yes, in Companies Act, what's the period? Anybody, Companies Act, how long do you have to maintain books of accounts? 8 years. There 8 years, here 6 years. Like for example, if you talk about previous year 21, 22, first you will see the assessment year. What will be the assessment year? 22, 23. What will be the last day of the assessment year? 31st March 2023. Last day of the assessment year plus how many years? 7 years. So till 31st March 2030. Sorry, 6 years. End of the assessment year plus 6 years. So till 31st March 2029, we'll have to maintain the books of accounts of 21-22. Now you understood, guys? You have to maintain for 6 years from the end of the relevant assessment year. So this was 44AA. In the first part, we said specified professionals maintain such books of accounts which will help the AO compute your income. Then we learned specified professionals. If your gross receipt is more than 1,50,000 in each of the 3 preceding previous years, then also maintain these extra books. Then we learned all other assessees maintain such books of accounts which will help the AO compute your income if your numbers are more than these numbers. Then we learned what about all other assessees? What if my assessee is not getting covered under part 1, part 2 or part 3? Then for them, it is not mandatory to maintain books of accounts. Finally, we learned you have to preserve your books of accounts for at least 6 years from the end of the relevant assessment year. All right, 6 years from the end of the relevant assessment year. In your answer paper, you will not write 7 years. You will write 6 years from the end of the relevant assessment year. Okay, so this is it about our discussion regarding section 44AA. Now listen to the next discussion, section 44AB. Listen. Just give me one moment. Listen. Our next discussion is going to be about section 44AB. What does 44AB talk about? 44AB talks about mandatory tax audit. Right? Now, this is one section which students think they know, but actually there's a lot of, confusion. You will see, first of all, whether your assessee is into business or is your assessee into profession. Just follow this chart, listen carefully. Assessee is into business or assessee is into profession. This is the first part of my discussion. If assessee is into business, point number 1, you will see, is 44AD applicable to the assessee? But still, he does not want to apply section 44AD and his total income is more than basic exemption limit. If all these conditions are fulfilled, then section 44AB will apply. He will have to get his books of accounts audited. Understanding what is my first point, what is my first situation? In my first situation, to my assessee, 44AD is applicable, but still he does not want to apply 44AD and his total income is more than basic exemption limit. If all these conditions are fulfilled, then 44AB tax audit is mandatory. Then in my second situation, to my assessee, 44AE is applicable. What is 44AD? Presumptive taxation for business assessees. What is 44AE? Presumptive taxation for assessees in the business of flying, hiring, leasing, goods carriages. 44AE is applicable to my assessee, but my assessee does not want to apply 44AE. Here, I will not look at total income number, only 2 conditions. If both these conditions are fulfilled, then 44AB is mandatory. In simple words, if my assessee is trying to, run away from 44AD or trying to run away from 44AE, then he will get caught under 44AB. Then coming to the third situation, you will see what are the total cash receipts of my assessee. The total cash receipts should be within 5% of total receipts. Okay, and you will see what are the cash payments of the assessee. Cash payments of the assessee should be within 5% of total payments. As soon as both these conditions are fulfilled, my assessee will immediately enter the third point. When will my assessee enter the third point? My assessee enters the third point if cash receipts are within 5% of total receipts and cash payments are within 5% of total payment. As soon as you enter into point 3, you cannot leave. Once you enter into point 3, either you will have 44AB or you will not have 44AB. Once you enter into point 3, I will see what your turnover is. If your turnover is more than 10 crore rupees, then you will have 44AB. But if your turnover is within 10 crore rupees, then you will not have 44AB. Story over. Then coming to my fourth point, if situation 1 also is not applicable to you, situation 2 also is not applicable to you, situation 3 also is not applicable to you, and your turnover is more than 1 crore, then section 44AB tax audit will apply to you. Please follow this sequence 1, 2, 3, 4. Please follow this sequence. What is my sequence? For my business assessees alone, I'm talking about right now. In my first point, guys, just another 7 to 10 minutes, okay, and we'll be done. My first point, 44AD is applicable to my assessee, but my assessee does not want to follow 44AD and total income is more than basic exemption limit. If all these conditions are fulfilled, 44AD will apply. Second part, 44AE is applicable to my assessee, but my assessee does not want to apply 44AE. Then again, 44AB is mandatory. Third part, if my cash receipts are up to 5% of total receipts and cash payments are up to 5% of total payments, if I enter into this point, I will never enter into fourth point. Once I enter into third point, here itself I will get the answer. If turnover is more than 10 crore, 44AB will apply. If turnover is up to 10 crore, 44AB will not apply. You're understanding? Like, for example, let me give you an example. My assessee's turnover is 1.5 crore. Okay. Cash receipts are within 5% and cash payments are within 5%. Now, will 44AB tax audit apply? Yes or no? No, right? See, as soon as cash receipts and cash payments are within 5%, you enter into the third point. Once you enter into the third point, you'll get your answer here itself. It's up to 10 crore, hence 44AB will not apply. Just because your answer is no here, you will not come to the fourth point. When will you come to the fourth point? Only if situation 1, 2, 3, none of them are applicable. But if you fulfill these two conditions, then situation 3 will be applicable. Once situation 3 is applicable, you will get your answer here itself. Did you all understand this point properly? Yes. Then what if my assessee is into profession? If your assessee is into profession, here you will have only two situations. Situation number 1, section 44ADA is applicable to the assessee, but the assessee does not want to apply 44ADA and assessee's total income is more than basic exemption limit. If all these conditions are fulfilled, 44AD will apply. Second situation, if situation 1 is not applicable and assessee's gross receipts are more than 50 lakhs, here again section 44AB will apply. Answer my question. When you talk about turnover, when you talk about gross receipt, when you talk about turnover, current year turnover or preceding previous year turnover? Current previous year turnover or preceding previous year turnover? Current previous year, not preceding previous year. See, when do you look at preceding previous year? TDS. TDS chapter 194 ACHIJ, applicable only to those individuals and HUF preceding previous year turnover more than 1 crore, preceding previous year gross receipt more than 50 lakhs. Are you understanding? Are you able to interrelate provisions? Yes. Here, when I say turnover gross receipts, I'm talking about current year turnover gross receipts. In TDS chapter, when you look at turnover and gross receipts in 194 ACHIJ, there you talk about preceding previous year turnover, preceding previous year gross receipt. Okay, guys, this is the first part of 44AB. Listen to the second part of 44AB now. What is the time limit? When are you supposed to get the tax audit done? What is the time limit within which you should get the tax audit done? You will see what is your 139(1) due date. Whatever is your 139(1) due date, from that we will subtract 1 month. That will become your section 44AB time limit. For example, let us say your 139(1) time limit is 30th November 2021, let us say. So we'll subtract 1 month. Your 139(1) time limit will become 31st October 2021. Okay, so this was my second point. Then coming to the third point, what if section 44AB is applicable, but still you are not getting tax audit done? 44AB is applicable, but you're still not getting tax audit done. Then what will happen? In that case, you'll have to pay a penalty. What will the penalty be? Anybody? The penalty will be two things you will compare. Number one, 0.5% of turnover. You will compare this with 1,50,000 rupees. Out of these two, you will pick whichever is lesser. This much penalty you will have to pay. And coming to one last point, some extra points. If my assessee has more than one business, will you see turnover of each business separately? What if my assessee has more than one business? If my assessee has more than one business, then all the businesses aggregate we will see. Aggregate, is it more than 10 crore? Aggregate, is it more than 1 crore? All the businesses aggregate we will see. But if my assessee has a business and my assessee has a profession, then what will you do? Business and profession, then what will you do? You will do for business alone, separate calculation, and you will see whether audit required or not required. Profession alone, you will calculate separately and see whether for profession audit required or not required. If for any one answer is yes, then both has to be audited. For business, you will see separately. For profession, you will see separately. Any one, if the answer is yes, then both have to be audited. Is this clear, guys? Shall I close 44AB? Right, 44AB we saw. When do you apply 44AB? We saw the sequence. Please follow the sequence. And after the sequence, we saw the time limit. Then we saw the penalty, and then we learned about the extra points. Okay, now let me take you to the next discussion, presumptive taxation, section 44AD. When does 44AD apply? 44AD, you have to fulfill some conditions. Condition number one, the assessee should be a resident. The assessee may be a resident individual, the assessee may be a resident HUF, assessee may be a resident partnership firm. Condition number two, who should the assessee not be? The assessee should not be a non-resident, first of all. Assessee should not be a company. Assessee should not be LLP, AOP, BOY, AJP. Please notice, assessee can be partnership firm, but assessee should not be LLP. This is a very few places you have differences like this. Condition number three, assessee must be carrying on a business, which means assessee must not be carrying on a profession. Assessee must be carrying on a business, and this business should not be the business of agency. This business should not be the business of applying, hiring, leasing goods carriages. Then number four, assessee should not be enjoying section 10AA deduction. What is 10AA deduction? SEZ unit. And number five, assessee's turnover should be within 2 crores. We have 5 conditions. If all the 5 conditions are fulfilled, then section 44AD presumptive taxation will apply. If 44AD presumptive taxation is applicable, then number one, I will ignore all allowances and disallowances under PGBP. I will ignore all allowances and disallowances. I will straight away calculate 6% of turnover in some cases, 8% of turnover in some cases, and this itself will become the PGBP of my assessee. If I apply 44AD, then my assessee does not have to maintain books of accounts under 44AA. Assessee does not have to get them audited under 44AB. Assessee will have to pay advance tax only the last month, only the March month installment. And even income tax return, a very simple income tax return, ITR 4S is available for the assessee. Are you following? We have 5 conditions. If all the 5 conditions are fulfilled, then my assessee can ignore allowances and disallowances, straight away calculate 6% or 8% of turnover as the case may be. That itself will become PGBP. Now, when do you apply 6% of turnover? When do you apply 8% of turnover? You will see what is the turnover of the assessee. Out of the turnover, you will see how much turnover we have realized in specified mode by when. How much turnover we have realized by specified mode by section 139(1) due date. On this part of the turnover, 6% you will calculate. Whatever balance turnover you will have, on this 8% you will calculate. Quickly calculate and tell me now. Total turnover of my assessee is 100 rupees. Let us say realized within 139(1) due date is in specified mode, realized within 139(1) due date is 40 rupees. Then the balance 50 rupees was, let us say, credit sale. Out of this balance 50 rupees credit sale, let us say 30 rupees we have realized. We have realized this 30 rupees in cash mode within 139(1) due date. Tell me what will be the PGBP of my assessee. Total turnover is 100. How much did we realize within 139(1) due date in specified mode? How much did we realize? We realized 40. Balance, you don't even have to see credit sale, cash sale, how much received, how much not received, don't even care. You just see how much you realized in specified mode within 139 due date. Entire balance, put it here. Okay, so 40 into 6%, here 24 rupees, 60 into 8%, here 48 rupees. This will become the PGBP of my assessee. Okay, it should be 2.4, sorry, 2.4 and 4.8. This will become the PGBP of my assessee. You're understanding? Did you understand this trick here? You see how much did you receive within 139 due date in specified mode? You put that under 6% bucket. Entire balance turnover, received, not received, received in cash mode, received in other mode, entire balance turnover, you put it under the 8% bucket. This is 44 AD. Okay, 44 AD, presumptive taxation for business assessees, 5 conditions. Then coming to our next discussion, section 44 ADA. 44 ADA. Listen guys, listen carefully. 44 ADA, condition number 1. Again, my assessee should be same thing, resident, resident individual, or resident HUF, or resident partnership firm, same thing. Condition number 2, also same thing. Assessee should first of all not be non-resident. Also, assessee should not be company, LLP, HUF. Guys, by the way, HUF also not allowed here. Okay, see, don't get confused. 44 AD assessee can be HUF. Okay, 44 ADA assessee can't be HUF. So company, LLP, HUF, AOP, BOY, AJP and all assessee cannot be. Then condition number 3, assessee must be carrying on a profession, and that means assessee must not be carrying on a business. And condition number 4, gross receipt of this assessee should be within 50 lakh rupees. If all these conditions are fulfilled, here you will not bother about specified mode, not specified mode and all. If all these conditions are fulfilled, 44 ADA will apply. You will ignore all allowances and disallowances and all. You will straight away calculate 50% of gross receipts. That will become your PGBP number, story over. This is 44 ADA, presumptive taxation applicable for specified professionals. Okay, and here this profession should not be any profession. It should be only specified profession. You know what the specified professionals are. Okay, now coming to one last concept, guys, section 44 AE. 44 AE talks about presumptive taxation for those assessees who are in the business of plying, hiring, leasing goods carriages. So assessee should be in the business of plying, hiring, leasing goods carriages. Assessee can be any assessee. Individual, HUF, firm, company, resident, non-resident, can be any assessee. But assessee's total goods carriages any time in the year should not exceed 10. If both these conditions are fulfilled, then section 44 AE will apply. Under 44 AE, what you will do is, number 1, you will ignore all allowances and disallowances. But which allowance, disallowance you will still consider? Interest to partners, salary to partners, this you will still consider. Guys, listen, this is very important. A lot of you may not be aware of it. You will ignore all allowances and disallowances, but interest I pay to partners and salary which I pay to partners, you will still consider. You will still allow it. All right. Condition number 3, how will you calculate PGBP? You will see how many goods carriages you own. Whether you put them to use or not doesn't matter. Put to use, you will keep that concept where? Put to use concept you will keep only in depreciation. You will see how many goods carriages you own. Out of these goods carriages, you will see how many are heavy vehicles and how many are other vehicles. Heavy vehicles means what? They can carry more than 12,000 kg, not at least 12,000 kg, more than 12,000 kg. Other vehicle means up to 12,000 kg. So you tell me exactly 12,000 kg, heavy vehicle, other vehicle. Other vehicle. If it is heavy vehicle, how will you calculate PGBP? You will calculate at 1,000 rupees per ton, per month, per vehicle. Other vehicle, how will you calculate PGBP? 7,500 rupees per month, per vehicle. All right, guys. Did you understand this discussion, everybody? Yes. So this is your entire presumptive taxation. Now listen. So I can say that section 44 AD is for business assessees. Here, what will the PGBP be? 6% of turnover in some cases, 8% of turnover in some cases. This total itself will become PGBP. By the way, guys, before I forget, thank you for reminding me, Sahil. Here, even if you have a fraction of the month, what will you do? Even fractions of the month you will consider as whole month. For example, 1 month and 2 days, you will calculate for 2 months. 7 months and 10 days, you will calculate for 8 months. Even a part of the month you will consider as whole month. Okay, so this was 4480, 6% of turnover, 8% of turnover, that itself will become PGBP. Then 44 ADA, what do you do in 44 ADA? In 44 ADA, you will calculate 50% of gross receipts, that itself will become PGBP. In 44 AE, here how will you calculate? You will do the calculation for heavy vehicles or other vehicles as the case may be. From this, what will you subtract? From this, you will subtract interest which you pay to partners. How much maximum you will subtract? Maximum 12%. From this, you can also subtract salary which we pay to partners according to 40B. Remember that 1,50,000, 90%, 3 lakh and all that. The net number, this is going to be PGBP. Please notice this in 44 AD and 44 ADA, no other allowance, disallowance. In 44 AE, we will have this allowance. Okay, if 44 AD and 44 ADA are applicable to you, then you don't have to get 44 AB tax audit done. You don't have to maintain books of accounts under 44 AA. You also have to pay advance tax only one installment, and even income tax return, simple income tax return 4S will be applicable for you. But in 44 AE, advance tax, how many installments we'll have to pay? Advance tax, all 4 installments you'll have to pay. See, even over here, if 44 AE is applicable, no need to maintain books of accounts, no need to get them audited. But advance tax, all 4 installments applicable. So what are the differences now? Advance tax point and these 2 points. Okay, one last concept, guys, one last tiny concept. I'll just finish it off. You remember I was telling you in entire PGBP chapter, everywhere we talk about specified mode. Only one place we talk about non-cash mode. Let me explain that to you. See, whenever the employer is paying the employees, whenever the employer is paying the employee's health insurance premium, for the employer, it's an expense, right? This expense, irrespective of the amount, whether less than 10,000, whether more than 10,000, this expense has to be paid in non-cash mode. Only for health insurance premium alone, we have a special point. If the employer is paying employees' health insurance premium, for the employer, it's a business expense. This business expense has to be paid in non-cash mode. Everywhere else, we talk about specified mode. Only this employees' health insurance point, only here we talk about non-cash mode. All right, guys. So are we all crystal clear with this discussion? PGBP, I hope it's feeling a little less of a burden. I'm hoping at least the session today has made at least a little bit difference to your preparation. That itself would be enough. All right. So with this, guys, I'll close here. I'm so grateful to you all for agreeing to stay till this long. All right. I'll try getting it uploaded. Don't worry about that. All right. So we'll close our session here, guys. I think we've covered all the points in quite a lot of depth. All right. So with all these provisions, you should be able to handle well. All right. I'll see you again tomorrow, guys. Tomorrow we will be doing the capital gains chapter. Okay. Same 6 o'clock. We will meet tomorrow again. In case you have any doubts, you can reach out to me on this number. Thank you, guys. Bye-bye.